I think we have another troubling inflation report that's going to come in March.
Enough people out there are spending that it creates inflationary pressure for everyone.
We're out of the world where inflation stays in that 2% lane.
Inflation falling to target is currently underappreciated by markets.
Inflation is still slowing, and I think it's probably slowing more than the consensus thinks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 negative by 0.1%. Deutsche Bank's Jim Reed, the run of a lifetime. 16 positive weeks out of 18 for the first time since 1971. It is going to be a long, long road to Friday, 8:31 Eastern Time. Bramo, we've got a double dose of Chairman Powell. We've got a State of the Union from the President and a payrolls report this Friday.
So I was thinking about this. Which is the most important aspect of all of these? Because it's really a blockbuster week across the politics, across the monetary policy, and across economic activity. And ultimately, I think it's got to come down to the jobs report. As much as there's so much comes out before that, ultimately, it's going to come down to whether the economy continues to grow at the pace that people expect.
The ultimate question, I think, for this week is whether February confirms January. And if it does, we've already had a big repricing at the front end of the curve. What does it mean for this Fed? And ultimately, what does it mean for this market?
Just to put that into perspective, what we are seeing is the market pricing out only a 25 basis point rate cut or less than that by June for the first time since October. We have not seen this type of lack of rate cuts being priced into the market since going back to late last year, yet markets aren't really alarmed about that. And that's what I think is a disconnect, because maybe people think they're just pushing it back. They're not deferring them indefinitely.
Another all-time high on the S&P 500 Friday at the close. We begin another week at record highs this Monday morning. AMH, we're looking ahead to Thursday night, 8 p.m. Eastern Time. The president, the political spin, he needs to find a new way to connect with this electorate.
It's not even so much, Jonathan, about what he says. It's how he says it. Because over the weekend, there was a number of polls, and the New York Times one shows that a majority of his own voters who voted for him in 2020 are really starting to get concerned about the president's age. What he's going to say, we know he's going to talk about his legislative wins, the CHIPS Act, Inflation Reduction Act, the Hard Infrastructure Act, abortion, all of these things. But it's really going to be how he says it. And if there's potentially any discussions with those House members, like there was at the last State of the Union, does he come off as someone who's strong and combative and can take down Donald Trump?
That's the final point. I think that's the most important one. Whether the president can get through a 60-minute address, that's how low the bar seems to be in some corners of Washington right now, Bramo. Can he get through a 60-minute address?
With projecting strength. I mean, right, it's sort of, if you start fading out toward the end, that's going to be pretty brutal. I think people are looking for strength. They're looking for resilience. They're looking for some sort of cohesion in the messaging, not just sort of trying to cater to one group and then another and everyone trying to placate. But to me, the Wall Street Journal did have a poll that indicated that people do feel better about the economy. Not that much, but, you know, on the margins, kind of shifting a little bit.
But they're not always giving the credit to the current president, because in all of the polls over the weekend, whether it was Fox, Wall Street Journal, New York Times, our recent poll in the swing state, they continuously show that Trump is leading him.
Personally, on Thursday night, I'm looking for a sneak peek at a payrolls report Friday morning, given the president may well know the outcome of that particular payrolls report.
You think he's going to release it? He's going to be
Bramo,
like,
I'm not saying
anything,
he will. I'm just
the...
saying, you know, personally, I'd like a sneak peek at a payrolls report on Friday.
Okay. Joe Biden, if you're listening, Mr. President, if you want to just say, you know, 250.
I'm pretty sure the president's still in bed. Anyway, let's pick out a single name right now. Macy's right now, getting a big offer. Arkhouse and Brigade going up to $24, up from $21. 33% premium to Friday's closing price. Lisa, this stock is up by 15% at the pre-market.
So Macy's didn't like the first offer. Hey, here's $1 billion more. Will you reconsider? My question is, what do they want with Macy's? Do they want the real estate? Do they want the retail business? How are they going to divvy it up and extract value from a company that did just come out and talk about scaling back some of their Macy's chains, but also scale up some of their higher cost brands?
The stock is up by something like 15%. We'll keep an eye on that through the morning. Let's start the morning with some price action for you. On the S&P 500, we're negative by 0.1%. We're pulling back just just a touch here, Bramo. Yields are higher by a couple of basis points. Your 10-year, 420.
So let's just go over how big of a week this really is. On a Tuesday, of course, we get Super Tuesday. 15 states and 1 territory do vote. We do get maybe the send-off for a Trump versus Biden rematch, which everyone's very excited about. On Wednesday, we get the JOLTS job openings. Powell is testifying in front of the House, which I know that you guys are going to be really interested in, all the searing questions that are not at all some of the punditry that we normally get in these. On Thursday, we get another testifying from Jay Powell in front of the Senate Banking Committee, and then non-farm payrolls on Friday. Again, non-farm payrolls, to me, arguably the most important after that State of the Union, because ultimately it will come down to whether people do feel that there is some sort of energy behind this market or whether it's overheating.
The estimate just sort of creeping higher over the last week. The median estimate in our survey, something like 200K. That's the week ahead. Here's the next hour or so on this programme. Laurie Calvasina of RBC Capital Markets with Wall Street boosting S&P 500 targets. Terry Haynes of Pangea Policy ahead of Super Tuesday and Biden's State of the Union address later this week. And Sheila Kahyaoglu of Jefferies as Boeing looks to buy its most important parts provider. We begin with our top story. All-time highs on the S&P 500 driving some big revisions on Wall Street. Bank of America's Savita Subramanian, the latest, raising her target to 5,400 from 5,000. And Laurie Calvasina of RBC saying there's more room to run. Writing this, quote, "We are still constructive on the stock market with a price target of 5150. Our most constructive model has been pointing to 54 and 5,500. Laurie, I'm pleased to say, joins us around the table. Laurie, good morning to you.
Good morning. Thanks for having me.
Let's get straight into the reasons to be bullish right now. What's the big one?
So the big one's coming from our valuation model, which is saying if inflation continues to moderate and we get a little bit of interest rate relief, the multiple can be higher than many people assume. That's been a very controversial discussion that we've had. I'll tell you the other model that we have that's starting to shift is our economic model. Typically 0 to 2% is a weak range in terms of GDP for the stock market. That's what we've currently got baked into the 5150. But if you look on Bloomberg and look at where the consensus is, it's moved up from 1.6% mid-February to 2% now. So the economic excitement that's coming out, I think, is another reason to get excited about stocks now.
It's funny that you went to multiples first, and I imagine the pushback you get is because a lot of people that have come on this programme, even those who have upgraded stocks, they're bullish on the earnings. They often don't talk about bigger multiples expanding. Where does that come from?
So, you know, it's funny. It comes from the summer of 2022. And I was building a new valuation model, and I had a lot of clients who frankly said to me, you know, if inflation is X and interest rates are Y, what should the PE be? And I said, oh, I have a little model that shows this. You know, it's more of a compass than a GPS, but it tells you can argue for, you know, multiples in the low 20s on a trailing basis, right? Not a forward basis. And people thought that was interesting. Eventually people said, what happens if you flex GDP assumptions? So we threw GDP into the model. And we actually found that if you look post-COVID, GDP is having a positive correlation with PE multiples. We haven't seen that in every decade. Our model goes back to the 60s, but there have been certain decades like the 80s and 90s where that did exist. So we think the things that are driving PEs are changing, and it's a very, very different dynamic than what we saw post-GFC. I think a lot of people are looking at post-GFC rules of the road. And that's really just kind of outdated, to be honest.
So David Kostin said the 4 most dangerous words in finance over the weekend, basically coming out and saying this time is different, and that people who are worried about some sort of bubble in the Magnificent Seven are getting ahead of themselves, that there is more room to run. Do you agree that this time is different, that the 16 out of 18 weeks of gains for the first time since 1971 is not a warning flag, but actually a sign to keep going?
So look, I've gone back and looked at this concentration issue every which way I can think about it. And if you just look at concentration spikes in the market, when the market cap representation of the biggest 5 or 10 stocks swells to a certain level, it doesn't give you a signal about anything. It just tells you that you're in a period where people either are about to be or have been nervous. We've been nervous for the last 4 years, right? So I don't think it's telling us anything except that nervousness is still out there in the market right now. What we do see is if you look at it from a PE perspective, the top 10 or the top 5 stocks are getting to levels that have marked peaks in the recent past, but the rest of the market still has a lot of room to run. And I think one of the things that's going to fuel rotation in the market away from those big stocks back to everything else is this idea that GDP expectations continue to improve, which should narrow the earnings advantage of those big names. I think they've done well for good reasons. Their time may be running out, but that doesn't mean they go down.
Savita Subramanian of Bank of America did come out. She upgraded her forecast to 5,400, talking about a 5% upward gain from here. You have a 5,150 target on the S&P for year end. You have a range
Yeah.
that sort of looks at 54, 5,500. Why have you not upgraded just yet?
So look, the thing we've been saying really since January or even in late December is that we thought this market needed to see a bit of a pullback. If you look at the AAII data or the CFTC data, it's really quite concerning. The AAII net bulls are basically hovering between 1 and 2 standard deviations above the long-term average. And typically you get a flat market over the next 3 months when that's happening and sort of, 6.5% type gains over the next 12. So it's not a, sort of panic signal, but it is a short-term caution signal. CFTC is actually a bit more concerning. NASDAQ futures positioning is hitting new highs, so it's as crowded as it's ever been. And on the broader U.S. equity market futures positioning, if you just look at the buy side in aggregate, we're above the highs that we've seen pre-COVID. We're above the highs that we saw in early 2018, and we're well above the highs that we've seen in 2021 through 2022. So I do think we've got to see some volatility in this market at some point. I think we're going to be higher by the end of the year, but it may not be an easy path.
When you see volatility, you mean pullbacks?
Yes.
5% pullbacks?
It's a funny question, John, because I keep getting asked, how big is this going to be? And I said, look, it can't be more than 10 because more than 10 is a growth scare. I think the economy, we're in the middle of ratcheting up expectations. If you're looking at that 5 to 10% range, maybe it is more like 5 than 10 because everybody wants the dip. And when I show people this sentiment work, they're very sympathetic to the idea that maybe the market's gotten a little bit ahead of itself. But when that happens, the dips do tend to be shallow.
I was struck by Citigroup credit card spending data that actually shows a reacceleration in people spending in the month of February. People keep talking about how we're going to get a deceleration. The indicators on the peripheries don't seem to suggest that. How do the people who you speak to, your clients, feel about where things are right now?
So, it's a very different conversation than back in August. So back in August, we were in the middle of starting to see interest rates move up. There were a lot of doubts over the Fed, and it was, oh my God, the Fed is going to tighten us into a recession. That's not the case now. Now it's, oh my gosh, the U.S. economy is so hot, we're never going to see cuts. And the emphasis is on the economy is so hot. And I think there's a begrudging acceptance in the investment community. I saw this in Europe a couple weeks ago. I saw this in the U.S. in my marketing last week, that this economy is really not nearly as fragile as people think. This is something we tend to see post-crisis. We saw it in 2002, 2003, and 2010, 2011, where there was constant fear of tipping into a recession that never happened. I've been starting to describe this as investment community PTSD. And there's a lot of sympathy for that. I mean, I think a lot of people who have been around for those periods in the market remember that. And they're like, when I point it out, they're like, yeah, you may be right.
What do you think of the likes of Torsten Slok saying potentially no rate cuts this year?
So I talked to my rate strategy team about this last week because I did have a few meetings where that was thrown out there. I think even before Torsten, sort of put that note out. And I've heard this in a few corners. And I give our rates team a lot of credit. They were never in the March camp. They've always been in the June camp. They've been making that call since last summer. And when I kind of pushed them on this late last week, they said, look, we do think these cuts were always about preventing a downturn, not, sort of arresting one in the middle of it happening. And so they do think the Fed is going to try to come out and, sort of defend sort of the employment side of the mandate and really try to keep the economy from going to a bad place. And I think that's right. They've also talked a lot about adjustment cuts. So as inflation moderates, do you want to be incrementally tightening from here? That's been their view for a long time, and they're sticking with that.
Torsten Slok, Apollo, by the way, 7:45 Eastern time, so about an hour, 30 minutes from now on this programme, breaking down that big call. Laurie, good to see you. Going to be sticking with us. Laurie Cavassina there of RBC Capital Markets. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China's Premier Li Qiang won't hold a press briefing at the country's annual parliamentary meetings. It's the first time in 30 years that China's #2 official will not take questions at the end of the annual National People's Congress. The move scraps one of the few events on China's political calendar where a top leader interacts with the public. Congressional leaders have revealed the detailed agreement to keep large parts of the government operating through September 30th. The $436 billion package includes provisions to prevent oil sales from the U.S. Strategic Reserve to China and to track foreign purchases of U.S. farmland. But it sidesteps lingering disputes over funding for defense, homeland security, and social programs. SpaceX successfully launched the Falcon 9 rocket from NASA's Kennedy Space Center in Florida on Sunday. On board, there were 3 NASA astronauts, a Russian cosmonaut heading to the International Space Station. The spacecraft is scheduled to dock with the ISS early Tuesday morning Eastern Time. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this programme, a massive week on Capitol Hill and Nikki Haley refusing to back down.
You did sign a pledge, an RNC pledge, to support the eventual nominee. Do you still feel bound by that pledge?
I think I'll make what decision I want to make, but that's not something I'm thinking about.
That conversation is coming up next, live from New York City this morning. Good morning.
It's a huge week in politics. Tomorrow, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kayleigh Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting tomorrow. Bloomberg, context changes everything.
Stocks on the S&P 500 here a little bit softer. We're negative by 0.2% on the S&P. Yields a touch higher by 2 basis points. Your 10-year 420.33. Under surveillance this morning, a massive week on Capitol Hill, and Nikki Haley refusing to back down.
You did sign a pledge, an RNC pledge, to support the eventual nominee. Do you still feel bound by that pledge?
At the time of the debate, we had to take it to where would you support the nominee? And you had to, in order to get on that debate stage, you said yes. The RNC is now not the same RNC. Now it's
so you're no
Trump's
longer bound
daughter-in-law.
by that pledge?
No, I think I'll make what decision I want to make, but that's not something I'm thinking about.
Here's the latest this morning. Voters heading to the polls in 16 states tomorrow for Super Tuesday. We get a double dose of Fed Chair Jay Powell on the Hill Wednesday, Thursday, and President Biden delivering his State of the Union address Thursday evening. Joining us to discuss is Terry Haynes, founder of Pangea Policy. Thursday evening, 8:30, 8 p.m. When we hear from the president, Terry, who does he need to speak to in this economy, in this country?
Well, he needs to speak to everyone, of course, but fundamentally, he needs to speak to to people who are unconvinced that he's up to the job, and people who are unconvinced that he's done a good job. Those are the people he needs to focus on. He needs to treat this thing, and I think he will, as not only as a de facto campaign speech, but to show that he's on top of the game and on top of the issues.
The Washington Post this morning has an opinion piece that says, give him hell, Joe, and keep the State of the Union shorter. They say he needs to become like Truman in terms of trying to stick it to Congress and blaming Congress. But he said Biden spoke for 73 minutes last year and what he called an inflection point in history. It is far less important for Biden to be comprehensive than it is to be compelling. Do you agree? Does he need to keep this short so he can keep up his stamina for this speech?
Well, I think he needs to be focused fundamentally. There is that stamina component, and I think that's fundamental both politically and to markets. So, the strength of and the certainty of the U.S. government underpins markets in ways I think they haven't thought about in quite some time. But yeah, the laundry list approach of this speech, which reached its apogee, I think, during the Bill Clinton days, and has never really gone away, absolutely needs to go. What voters need to hear, what citizens need to hear, is something shorter, punchier, and more focused on what the speech is supposed to be, the State of the Union, and a little less about whatever the laundry list of the government is supposed to be.
Terry, we had a lot of polls over the weekend. Fox News, New York Times, Wall Street Journal. Dismal figures still for the sitting president. Should the Democrats start to be more worried than they already are?
Well, if you got the New York Times leading with saying it's time for bedwetting, where the political center is on a lot of this stuff. I think Biden's people will do what they did in 2020, which is to get out the vote and not take any of those votes for granted, number one. But no, I don't agree that it's time for panic. My view on this for quite some time now has been that you see weakness in Trump and you see a third party challenge that hasn't quite gelled yet. Trump's weakness really comes down to, his base is still there, but his base isn't by no means everything. What he really needs is he needs a party unifier, which he's not going to get, and independence, which he's also not going to get. So there's very much a path still here for the president if he wants to take it, and again, not take any of those votes for granted.
Terry, what do you make of Kamala Harris coming out and taking a harder line with respect to a proposed ceasefire between Israel and Gaza, Hamas? How much do you see this as sort of the new role that she's going to try to take up?
Well, I've said for quite a while now that I think people ignore Vice President Harris at their peril. She's very unpopular, generally speaking. Her gaffes and whatnot are well known in the political class. But at the same time, she's got constituency, and there are places in the Biden constituency that she can speak to and be very effective. And one place there, frankly, is in a situation like Israel-Gaza, where the Biden people are trying to speak to the Palestinian community in the United States and abroad. And so her being out there on that stage has the possibility of being very effective for the administration.
Terry, can I just ask your thoughts on the future of Kamala Harris? She's young, certainly very young, compared to the president, with a lot of runway for her career still left. How does she avoid becoming, say, the next Mike Pence with no political future if the president doesn't win this election?
What she needs to do, firstly, if the president doesn't win this election, firstly, she needs to be seen as an effective partner in the election effort, firstly. Secondly, she needs to be seen as someone that did not contribute to that election defeat, assuming that that's where we are. But thirdly, she's still well thought of by the progressive wing of the party. That's where the energy is. That's where the money is. And she can continue to be a player there. She's going to have to get over the speed bump she's created in her career as vice president to do that, but an effective campaign performance can go a long way there.
Terry, appreciate your time, sir. As always, kicking off the week there with Terry Haynes of Pangea Policy on the week ahead in Washington, D.C. Laurie Cavacina of RBC still with us. Laurie, I've quoted you about 1 million times already this year, and it's regarding politics, and it's your quote where talking to clients seems to be like staring at the sun when it comes to politics down in Washington. Has it got better?
It's gotten a little bit better. I mean, I think my colleague Amy, Lou Silverman, put it this way. She said there was sort of a begrudging willingness over the past week to look at this issue a little bit more than the past. And I think that's right. I would still say investors are squinting pretty hard, and it's still pretty painful. We'll see what my call volume is like later this week. But after both Iowa and New Hampshire, those were the questions I was dealing with. And I talked to one investor, and the way he put it was, I got burned by Trump in 2016, didn't pay enough attention, so I've got to look at this now. And I don't think U.S.-based investors are doing a whole lot right now. I'm getting requests for what does the historical playbook look like around elections? What did well when Trump won? Small caps are coming up a lot right now because back in 2016, they were a Trump trade. They were another Trump trade in 2018 on the trade war. So whether you think we're going to have, sort of a Republican administration that, really cuts taxes, reinvigorates the consumer, or we have a more isolationist foreign policy, both of those seem like Buy America trades, and small caps line up nicely with that. So we're having conversations like that, but to be honest, John, there's just not a lot to do right now because there's nothing but breadcrumbs to analyze.
Well, but that's exactly the reason why. In some ways, I'm more interested in the jobs report. You said you might be more interested in the State of the Union in terms of a market-moving and interesting kind of event. How so, from a market's perspective?
I think it's more hope that I'll have something other than breadcrumbs to analyze at the end of the week. I feel like I've been educating a lot of European and Canadian investors about social issues driving our elections, which is interesting and matters to the turnout and who will ultimately win. But ultimately, there's not a lot to invest around on that. So I think I'm just hoping my job will be a little bit easier at the end of the week.
I think we're all trying to work through the breadcrumbs. Brammer, the question I've been asking, I think you've asked it as well, is whether the Trump trade is different this time around, how different it might be.
If the protectionism comes out before some of the fiscal boons, because frankly, there just isn't that much room given how deep the deficit is and how much pushback we've heard from his Republican Party.
Last time around, it was tax cuts, then it was tariffs. And you just get a feeling that this time around, it might be tariffs up front.
And that's going to have a very different effect when he's talking about 60% tariff on China, when he's talking about keeping things in America. You wonder whether he will go through with it in the same kind of way and whether he'll be that much more so, given that it would be his last term.
Laurie, it's going to get better. as the year grows older, I promise.
I hope so.
I hope so too. Laurie Cavacina of RBC. I mean, that was more hope from me than it was conviction. Equity futures right now on the S&P 500, negative here by 0.2%. Coming up next on this programme, Sheila Kahyaoglu of Jefferies on Boeing's bid for Spirit Aerosystems. That conversation just around the corner. A monster week still ahead. A double dose of Chairman Powell and a big payrolls report on Friday. Live from New York City, this is Bloomberg. Two days of gains on the S&P 500, two-week winning streak as we kick things off this Monday morning, pulling back just a touch. We're down by 0.2% on the S&P, on the Nasdaq down by 0.1%. 15 all-time highs this year already on the S&P 500 and tons of upgrades over the last week too. In the bond market, we look like this. The two-year yield falling back for 4 consecutive days into Monday. A little bit higher this morning by a couple of basis points, 4.55. Think about where we were a week ago. We closed above 470 for the first time this year. Lisa, we're back down to 455 a week later.
And just because we got some weaker than expected reports, that when you look under the hood on Friday, people were saying they're not as weak as they seem. But even after the hot CPI and PPI, a hot everything else, and the hot labor market report and the hot everything, this is what people cling to because they want the soft landing, and that's basically what they're honing in on.
A second week of dollar weakness as well. Let's push that through foreign exchange. Actually, last week as well on the Japanese yen, I think that was the first week of yen strength so far this year. It was really, really marginal, Bramo, but it was there off the back of maybe we get some action sometime soon.
Given the fact that there was some discussion that maybe hinted at some sense that they're getting closer to their 2% target, I have to say Japan is fascinating because people talk about the flood of cash into their equity markets and how much is this a boon and how much is this just simply they've been kind of going nowhere since 1989 until now.
Yes.
And it's sort of kind of waking up from the slumber.
Going to come back to that point in just a moment. I think it's really, really important. Just to finish on the euro, 108.55 on that currency pair. I know this is not exactly value add, but doesn't it feel strange the ECB is Thursday? It doesn't feel right.
You mean because
something sort of not
no one
right about
cares?
that? It's like a 2-week gap between them and the Federal Reserve, which just feels a bit off.
You think that it should be the day after? It should be like bang, bang,
yeah,
bang, bang.
Absolutely, like back to back, compare and contrast. I don't know about the thing, but sure, back to back is helpful. Under surveillance this morning, our top stories, Vice President Kamala Harris now calling for a temporary ceasefire between Israel and Hamas. Talks are planned between delegations in Cairo, but Israel is not expected to send representation without certain information from Hamas. Today, Israel's Benny Gantz, a member of the country's war cabinet, will visit with Harris at the White House. The news comes after US and Jordanian forces have started operations to airdrop aid into Gaza. Annmarie, I'm trying to work out if this is just a natural evolution, further progress in the administration's position, or whether this is Kamala Harris putting some distance between herself and the president.
I think what this is the administration trying to put some distance between themselves and Netanyahu and trying to ratchet up that pressure as they know they're going into these talks for a ceasefire. And we do know that Israel decided not to send a delegation, although over the weekend, U.S. officials had said there is something on the table if Hamas agrees to send back the hostages. The most important thing you read, Jonathan, in that was that Benny Gantz is going to be in Washington. Israeli media, local media, is talking about how Netanyahu is fuming about this. And in a tense phone call he had with him before this trip to Washington he's making, he said, just remember, there's one prime minister in Israel.
I saw the same reporting as well. Lisa mentioned Japan. I want to turn to that just briefly. The equity rally gaining some big-time momentum over in Japan. We've got the Nikkei 225 surpassing 40K for the first time ever. Foreign investors bringing funds back to the market after posting net outflows for 6 of the last 8 years. Bloomberg also reporting the government is on the verge of calling the end to deflation. Some big changes potentially over there. Expectations are growing. The BOJ will hike rates in the coming months. The next BOJ decision is March 19th. So 40K, line in the sand, you can draw it all the way back to the late 1980s. That was the last time we threatened to go through 40K. We're through it today. I wonder what the takeaway is for you here, Lisa, but here's the takeaway for me ultimately, that it took this long. That for the buy equities, they only go up crowd, that there is evidence that you can have lost decades in equity markets. You can just look abroad for them. You'll find them in Japan.
And that now we're catching up and people are saying, flood the markets, get back in. Is this some sort of rip-roaring surge that people are going to try to sell out of? Or is this just basically re-embracing Japan as a global market? Basically saying, look, we're finally seeing growth again. We're finally seeing cross-border investment, unlike what we've seen before. Because how many of the companies, yes, are hinged to this lack of deflation suddenly, but also to the U.S. government, right? And to the U.S. economy in a new kind of way.
It's a policy effort that is decades in the making, potentially calling the end to deflation. That stock market, by the way, year to date, up 20% on the Nikkei 225, positive by 20% over the last year, which is just absolutely amazing. Let's turn to a big mover in the pre-market. It's Macy's. Investors raising their bid for Macy's after being rejected in January. Ark House Management and Brigade Capital Management are offering 14% more. The increase coming at $24 per share. That's a premium of a 33% to Macy's closing price on Friday. Macy's unveiling a restructuring plan which would close a third of US locations and grow the Bloomingdale's and Bluemercury brands. That stock is up, Lisa, by a little more than 16%. I think we talked about this last week. Just how defensive was that to close their stores, to focus elsewhere? Was that about getting a bigger offer from those investors, or ultimately saying, we can do this ourselves, we can go it alone? I
guess we'll find out. This is exactly the litmus test that we're about to get, given the fact that they rejected the first offer by saying it lacked compelling value. Does it offer compelling value at 14% higher? I mean, this is sort of the key question, right? What are they looking for? Was it the plan, or was it just dollars and cents?
33% premium to Friday's close. Is that not compelling enough?
Well, compelling in terms of vision, too. What are they looking for? Is this basically a question about not going private or not being owned by private asset managers? Or is this something that just really has to go to hard, cold cash? We don't know, given the fact that they did make some pretty big moves that did seem to suggest that they recognize the concern.
Macy's is up by something like 16%. I want to talk about Boeing as well, confirming it is in talks to buy former division Spirit Aerosystems. The parts supplier is at the center of issues affecting the 737 MAX jet. Boeing saying in a statement, quote, "We believe the reintegration of Boeing and Spirit Aerosystems manufacturing operations would further strengthen aviation safety, improve quality, and serve the interests of our customers, employees, and shareholders." Sheila Kahyaoglu covers both Boeing and Spirit Aerosystems for Jefferies and joins us now. Sheila, let's talk about the potential of this deal happening. Can you just talk us through the history of that division and why reintegrating it may well be the best move for both companies?
Sure. So Boeing went through a period where it outsourced, and then it went insourcing, and it had a partnering for success. Technically, in a great world, Spirit could make a 10% operating margin and Boeing could do 20%, and we'd all be happy, shareholders and investors. But that's not the case. Spirit is struggling. It's losing money. It's hemorrhaging cash, actually, and it's trading on a 14% free cash flow yield versus 7% historically. So clearly investors don't believe the cash flow. It had a massive cash outflow last year, a debt refinancing that it was able to do. It has a new CEO in place, somebody off the board who's a Boeing 30-year veteran. And so Spirit is trying to fix itself up, but folks don't believe that it's going to stop losing cash. So what is Boeing saying? Boeing is saying, I'm losing market cap because of Spirit's issues, so best to in-house it and control it. Now, I think it's up for debate. What's the best solution for Boeing? Do they put two board seats in and sort of manage it from afar? Do they take it over completely? Boeing has had its own supply chain issues, not only due to Spirit, but mostly due to Spirit.
So not to be too basic about this, but do we really know what went wrong to begin with? Was it Spirit Aerosystems, or was this a Boeing problem? Do we have a sense?
What went wrong where? There's been a lot of issues. So there's been a lot of issues. You know, when we look at the 787, that was a Boeing and Spirit issue. We didn't have 787 deliveries for essentially 2 years. And then Spirit's been the cause of the recent hiccups. Now, it's the cause of the 737 hiccups. And it's such a big deal because the MAX is about 60% of Boeing's free cash flow. So when you're stuck at a rate of 20 a month and you're supposed to be at 40 a month, what's the cause of that issue? It seems like the engine manufacturers and the metal folks are out of it. They've sort of had employees tick up, and they're increasing capacity, so they're off the hook for now. So it all comes back to Spirit. And what's the best way to fix it? Now, Pat Shanahan, the Boeing veteran, just has been there since October. So it's only been 4 months.
So the regulators, they're coming in, they're saying, we don't really understand what your plan is. They say that there seem to be some really problematic cultural issues, a lack of certain clear signals about how to have safety controls. What are they thinking right now, given the fact that this is it? This is the only game in town for the United States when it comes to plane making.
Yeah, so I think the regulators almost take a regulatory view and that's it. They're not going to manage who's managing these companies, who's investing in them. They just want to, reading, what they put out, they just want to sort of check the box and say there's safety protocols to the extent they can. They're not, Boeing is not a nationalized company. They can't go in and, sit there forever as they've been scrutinizing the MAX line. So I think the regulators have a very hard line to draw, and so does Boeing management. It's like, how involved do you get in the supply chain? What's okay? And so perhaps that's resulting in this latest move, is that maybe we need to be completely involved and completely take it in.
Given they are buying back Spirit, do you foresee any hurdles when it comes to the regulation?
I think maybe one of the hurdles is Airbus. Spirit manufactures about 20% of its output to Airbus. It's diversified over the past decade as it's needed other sources of cash, but that business is losing money. So perhaps, obviously, Airbus is not going to let Boeing take that in-house, so that would be divested. At what price, given it's losing about $200 million of free cash flow annually? But, I don't know about the regulatory hurdle in terms of what it means for in-housing. I mean, it means Boeing has more control over the supply chain, and are the regulatory bodies okay with that?
If this was any other industry at all, with only two major competitors, and the one was going through what Boeing's going through right now, you'd think the other one was just sitting there rubbing its hands. How does Airbus take advantage of this situation for Boeing? How can they do that?
It really has taken advantage. So Airbus basically has 60% market share of the narrow-body market, where the MAX plays the A320. And it's particularly done well on the A321 because we don't have a MAX 10 certified. And the MAX 10 is 10% more capacity, and that's what airlines like United are very focused on, right? And if you look at the United 10K came out on Friday or Thursday, they're cutting their aircraft intake by 50% for this year, their contractual intake. And that's one of the largest carriers in the world, right? So that means there's a shortage, clearly. So Airbus has taken share 60%. But it really can't go beyond that because it can't deliver sooner than 2028 or 2029. On the wide-body market, Boeing's still doing really well. It has 60% share because the 787 is the dominant aircraft there over the A350.
Can you put prices up if you're Airbus? How easy is it to do that?
One would think. I mean, I think that's the play. Even in a global duopoly where both are successful, pricing should be up because airlines are telling you Ryanair cut their summer schedule by 20% and raised airfares by 10%. So airlines are telling you we need these planes. We'll probably pay a good price for them. So I think, assuming Boeing and Airbus are very healthy players, they should both be able to increase prices.
Really looking forward to catching up with Michael O'Leary at some point in the next few months. We've got a ton of questions for the Ryanair boss. I wanted to finish with this one just quickly. Whether that incident in the last 3 months, violated that deferred prosecution agreement with the government, and whether ultimately Boeing could face criminal liability. What are you telling clients about that at the moment, from the professionals, the experts you speak to? How close are we to that happening?
I can't opine on that, but I think that's just not, it's Boeing manufacturing aircraft. I don't know where the criminal element comes into that. And, we could regulate banks, we could regulate aircraft manufacturers. At what point do we go too far?
Sheila, it's good to see you. Sure. Ready to catch up. Sheila Coley there of Jefferies on the latest with Boeing. And Michael O'Leary, if you're watching, I know sometimes you are. We want to make that happen soon, don't we, Bramo?
Yeah, especially because they're going to buy some of those MAX 737 jets. I mean, this is basically my question. Are you going to have lower-cost airlines saying, if you want to sell your discounted Boeing planes, we're your guys, and, the other airlines are forced paying a premium for Boeing, for Airbus, rather.
I'm not sure how much of a marketing scheme that actually is, but OK. Looking forward to that. Coming from an airline near you, apparently. Equity futures right now on the S&P, negative by 0.2% on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Santander is said to have cut about 320 U.S. jobs. The source says about 2.7% of employees in retail operations across U.S. branches were recently let go. Santander told Bloomberg it's updated its staffing model and is investing in digital capabilities. Shares in Macy's are higher pre-market after investors boosted a takeover bid. Arkhouse and Brigade increased their offer by 14%. It's now at $24 per share, up from $21. It's also a 33% premium to Macy's Friday close. They had earlier rejected a bid in January and instead unveiled a restructuring plan where they'd close a third of the Macy's locations while growing Bloomingdale's and Bluemercury. California and parts of the U.S. West Coast are set to face more dangerous wind gusts and deep snow to start the week. Already, days of winter weather have blanketed the area with as much as 8 feet of snow. The deadly conditions forced road closures between California and Nevada. Meanwhile, Amtrak canceled trains across the region. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, the ECB preparing to cut.
I think June is going to be a massive month for markets. I think the Bank of England, the Fed and the ECB are probably all going to cut rates. And then it's a question of how far they go.
That conversation is coming up next, live from New York City. This is Bloomberg. Stocks negative. We're down by 0.15% on the S&P 500. In the bond market, yields higher by 3 basis points, 421 on a 10-year. Quick check of the euro against the dollar positive by 0.2%, 108.57. Under surveillance this morning, the ECB preparing to cut.
It's entirely possible that we're just adjusting here to a higher growth, slightly higher inflation environment. We've completely left the low interest rate world, and we're just having a little bit of a problem here, and central banks are having it too, just understanding what's the normal rate of growth for real GDP, where will inflation settle at, and what interest rate will you need just to balance the economy. I think June is going to be a massive month for markets. I think the Bank of England, the Fed and the ECB are probably all going to cut rates, and then it's a question of how far they go.
Here's the latest. Investors betting on June for an ECB rate cut ahead of the bank's meeting on Thursday. It's the first of decisions before the BOJ, BOE and Fed in the coming weeks. Rubber Bank's Jane Foley saying this: we don't see the first really live ECB meeting before June, with risk that September may bring the first rate cut. There may be the risk of a technical move in the refinance rate to narrow the corridor this month. Jane, I'm pleased to say, joins us now. Before we get into that technicality, Jane, let's just talk about the risk of the ECB cut being pushed out even further, out to, say, September. What's behind that?
Well, quite simply because they do have an inflation target, and they've told us that they're really watching the labour market dynamics. And we know, parts of Europe, like there are in the US and the UK too, that there are still labour shortages. This, of course, is related to the ageing demographic. It's not something which can be cured really simply. But, we look at that service sector inflation. We can pick any of those economies. You could even throw Japan certainly into this equation too. You look at the service sector, we know that labour is the largest part for the bills of most service sector companies, and labour shortages suggest that the service sector inflation is therefore going to be sticky. That's what we've been told, and the ECB have got a very straightforward vanilla inflation target, and that's the risk therefore that they may delay beyond June until September.
John doesn't think that the ECB meeting should be held on Thursday. He thinks it should have been held in tandem with the Fed's meeting. And I am curious about that in terms of, are they kind of dependent on one another, or rather ECB kind of dependent on the Fed and the fact that it's getting pushed out further for the U.S. And so it gives the freedom to the ECB to push it out a little further as well?
Yeah, I think there is certain, justification for that. And we only need to look at the exchange rate to get that justification, because, whoever goes first or whoever goes more aggressively could see their exchange rate dropping. And given that we're still in an inflationary environment, inflation is generally higher than the target rates in most countries in the G10. Well, they don't necessarily want that. So it could be that if we do begin seeing a continued resilience of the US economy, this debate appearing that maybe the Fed could wait until after the US presidential election, because obviously the timing of that could thwart some of their the chances for them to go. So that could certainly impact other central banks because of the impact or the potential impact on the exchange rate.
With that in mind, how are you watching Fed Chair Jay Powell's testimony to the House and the Senate later this week, given that we've heard a slightly different tone from him than some of the other Fed members? But honestly, the economic data has jerked around markets more than some of the recent rhetoric.
Well, to be honest, I do think it is going to be the data over the next couple of months that's going to feed everybody's outlook, including, Chair Powell's. The data on Friday, of course, is going to be really, really important, as then, the next month's worth of CPI and PCE data, all of that, put together is going to form the opinion of whether or not they can go in June or not. Now, our view last year was that the first move for the Fed would be June. And when we sort of announced that appeared very, very hawkish compared with what the market was thinking. No longer the case. But if this data continues to be sticky, there is the possibility that they could certainly delay until later in the year. And that, I think, is something which the market is going to be looking for very, very closely.
Our Bloomberg survey shows that lowering interest rates too soon would be worse than reducing too late when it comes to the ECB in the survey of economists. Do you see the same, then, justification for the Fed?
Absolutely. No policymaker wants to be associated with a policy mistake. And I think right now, the risk is that they could make a mistake and they could cut too soon. Inflation could remain far stickier for longer, because we know that that's the risk already. And we've already talked about wage inflation being sticky. But, what if, we get a Trump president? What if he announces those tariffs that he's already been talking about? That could be inflationary for the US economy. That's going to be something, for next year. But certainly, if that were to happen and the Fed, has cut perhaps too much or too soon, well, they're still going to be the ones, in the spotlight having to explain those moves. So certainly, I think for most of the G10, they will probably like to hold on longer and then maybe cut a bit more aggressively than go quickly and then be perceived as having made a mistake.
Speaking of another G10 currency, can we talk about the Japanese yen? Jane, a glimmer of yen strength last week for the first time this year. A conversation about maybe some kind of imminent rate hike. We've got the Japanese government considering calling this whole regime deflationary. This is decades in the making, Jane. How close are we to an interest rate hike from the BOJ?
I think we are very close. But, the caveat here is that when we do get that hike, assuming we get that hike, it's probably going to be very, very little. And we're not going to get, progressive quarterly moves. Maybe we'll get one more small interest rate hike this year. Maybe we won't. And I think that's what the market's been adjusting to these last few weeks. But we did have a really interesting piece of data out overnight, and that was capital expenditure. It was huge compared with what the market was expecting. Now, of course, in Japan, they've got the worst demographics compared with anywhere else. And companies are desperately trying to invest to try and replace labour, because there isn't much availability of labour. That expenditure figure, capital expenditure figure, was huge. And that could mean that GDP for the fourth quarter is revised up, which would have meant that Japan didn't fall into technical recession at the end of last year after all. So, that's a positive. But certainly looking through the speeches from the Bank of Japan officials, they're telling us that they've made preparations for a move in interest rates. And I think if it's not March, I think April is the most likely date for that.
If we had a list of worries, just theoretically, if one of us had a list of potential tail risks that things could go wrong this year, last year it would have been that the Bank of Japan suddenly hikes rates pretty dramatically, that the ECB cuts rates much more aggressively than the Federal Reserve, that the Federal Reserve cuts rates more aggressively. There are all of these potential tail risks. Right now, what do you think is the biggest central bank-driven risk to markets?
Well, it's still that inflation just remains stickier. And I still think that from just an economic sense, it comes back to the labour market. The labour market just been really, really tight. Now, of course, we can throw in geopolitics to that too. The Red Sea, for instance, I think, we've already had the ECB make a reference to that. That could come through. The possibility of Trump tariffs, again, adding to inflation too. So it's still the risk to me that we've got to a completely different environment, and one in which inflation is just going to be a lot stickier than we were accustomed to in the post-global financial crisis years.
Jane, just quickly, favourite trade right now, Jane, for you and the team at Rabobank, what is it?
I think we should look at the Swiss franc. There is a chance come March that they could be a lot more hawkish than we think. So, keep an eye on the Swiss franc.
One for TK. Jane, thank you. Jane Foley of Rabobank. Loves the Swissy. Loves the Swissy. That and the Turkish lira. We miss that, don't we?
Well, we would have started the show.
Every morning it turned to me.
Exactly.
I know, every single day.
State of the Union, it's jobs report. Check out the Swissy.
Dollar Swiss. Right now, I want to check out Kit Jukes of SocGen. Great note this morning. The dollar is reliant on a diet rich in US exceptionalism. Big week for economic data.
Especially given the fact that we get the JOLTS report on Tuesday, sort of the front runner, the ADP on Wednesday, and then we get the jobs number on Friday. How much Do we get those concerns about an overheating economy that accelerate if we get a hot labor market? To me, that's got to be one of the biggest risks to markets right now.
Sneak peek at the survey at the moment. I'll go through the numbers for you. Median estimate in our survey. These numbers can change. More estimates will come through. 200,000 is the median estimate at the moment. The previous number last month, as you know, was just a monster 353,000. Our survey indicating unemployment will stay at 3.7%. Going to be laser focused again on wage growth.
Given the fact that this is really an inflation story, there are two schools of thought here. One, there are people saying, look, we're getting growth, but it's disinflationary growth. It's the perfect sort of, it was all just transitory. And then you have other people saying, when you get growth like this, it is unsustainable without some sort of inflation. And if you get that wage growth, that'll feed into the latter scenario rather than the former.
Are you struggling for things to put on your list of worries? Is that what that question was about?
I mean, kind of. I mean, it was sort of extreme moves by the Fed, the ECB, the Bank of Japan. They seem pretty, pretty happy just to let things go. There's this question of accelerating one way or another. Yeah, and what do you have?
I've got a solution for you. Up next on the programme, Nuria Rabini of Rabini Macro Associates. Catch up with him. Torsten Slok of Apollo. Torsten with a big call, saying no rate cuts in 2024. Torsten joining us in just a moment. And we'll catch up with some of Bloomberg's best, Michael Shepard and Enda Curran. That and a whole lot more. Live from New York City, the second hour of Bloomberg Surveillance. Up next.
The longer rates stay elevated, of course, the more likely it is that we have some type of financial accident.
I think the risk is that the Fed goes less rather than more.
At the end of the day, we are seeing no urgency on the economic side to cut rates.
We still have an expectation of 4 rate cuts this year. We think that the Fed will start in June.
I'm at 1 to 2 cuts this year. I'm not at Torsten Slok 0 cuts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. Good morning. Live this hour, Torsten Slok of Apollo on why he thinks you'll get no interest rate cuts in 2024. This week, a double dose of Chairman Powell. Bramo, he's got a big question. Can you cut interest rates when stocks are at all-time highs?
Can you cut interest rates when you have a fully employed America, to quote someone we both know? Can you cut rates if you have a feeling that this economy isn't slowing down and may even be heating up? And it is a huge question, not just for Chair Powell, but also for the State of the Union, and also for a lot of people in markets that are sending stocks to all-time highs.
AMH, I'm going to say this on repeat, I think, over the next couple of days. Monster week on Capitol Hill over the next few days.
It absolutely is. We're going to get Jay Powell in front of the House and as well as the Senate. You have Super Tuesday tomorrow. It's all but done, so not so Super Tuesday, but it's an important day to see. You can read some of the tea leaves and who's going out and voting in some of these states. But then for me, the biggest is going to be the State of the Union in terms of Biden's performance, because poll after poll over the weekend showed he's even losing voters in terms of how they're feeling about him. The ones he gained in 2020, but they think he's just too old. So for me, it's less what he says, how he says it. Washington Post this morning saying, give him hell, Joe, but keep the State of the Union shorter.
Equity markets all-time highs. Unemployment sat at 4% for something like 24 months, maybe even more than 2 years based on the data we get on Friday. And somehow he can't connect with this electorate. Somehow this electorate thinks this economy is doing poorly.
This electorate has a lot of issues on its mind right now. And I will just say that you can't speak of the electorate as some sort of monolith, because you have people who still are grappling with prices that are much higher than they were a couple of years ago. We talk about the sort of collective or the buildup, the residual kinds of inflation. But there's social issues. There's a feeling of which political party you belong to. There's a feeling of some of the, which kind of media you're hooked into. I mean, these are things that are real.
You're hooked into Bloomberg right now. We can talk about all-time highs without the politics. And we'll talk about strategists on Wall Street upgrading their targets. In the last week, UBS, Goldman, Piper, Barclays, Bank of America, Savita Subramaniam joining the team. A handful of upgrades. So we've got Goldman Yardeni at 5,400. Savita now 5K out to 5,400.
So let's just frame this out. This sounds bullish when you talk about the upgrade. It's only a 5% gain from where we are. She's talking about the likelihood of a potential pullback before you get that said 5% gain. So it's sort of basically coming to the market and saying it doesn't look completely unsustainable, because guess what? Big tech is actually delivering the goods, delivering the earnings. We can't bet against them and just call it a bubble and go home and hide.
It did again last week, up up and away. Equity futures a little lower. We're down by 0.15% on the S&P 500. In the bond market, yields higher by 2 basis points, 420.33. Big hour coming up. Nouria Rabini of Rabini Macro Associates as the S&P 500 hits another all-time high. Bloomberg's Ender Curran looking ahead to the China National People's Congress, and Apollo's Torsten Slok later this hour on his call for no Fed rate cuts this year. We begin with our top story. Wall Street strategists racing to upgrade targets as the S&P 500 posts its 15th record high this year. Nouria Rabini of Rabini Macro Associates writing this: equity valuations are high and some correction may occur, especially if a growth slowdown weakens earnings growth. A soft landing is best for equity markets as a growth slowdown with rate cuts and lower bond yields lifts equity valuations. Nouria is with us through much of the next hour around the table. Nouria, good morning to you, sir.
Good morning, John.
It's good to see you. I was reading through some of your work, and I have to say, it didn't seem like you were worried about too much in this economy, in this market. Is that right?
Well, I'm less worried than the past. I think a year ago, people were worried about a hard landing. Then they started talking about the softish landing with a short and shallow recession. Now people talk about a soft landing, but there is serious possibility of what people refer to as a no landing, that growth remains above potential, and inflation remains sticky. And actually, of all scenarios, the one that is more risky for the market compared to a soft landing is a no landing, because markets were pricing in 6 rates cut by the Fed earlier this year. Now they converge to what the Fed is telling us, only 3 cuts. But what if growth is well above potential because of technology or other factors, and then the Fed doesn't cut 3 times, only 2 or 1, maybe some people say 0. Last year, revisions of expectation about the Fed in August and September led to a 10% correction of equity. So I think that's potentially, paradoxically, that good news on growth, maybe bad news for the market, if that implies the Fed is not going to cut as much and as soon as people expect now.
So just to put it in a headline, Nouria Rabini thinks the biggest risk is upside risk.
Right now, yes, because the data on Q4 suggests the growth well above potential, and even Q1 suggests that maybe growth is going to be around 3% plus. We're not having a landing of the economy in spite of the Fed cutting rates.
So just to put another headline in this, even Nouria Rabini is optimistic. I mean, we're looking right now, people looking for reasons to kind of gut check a runaway record rally that we've never really seen in this kind of environment. And the gut checks aren't coming. Does that sort of give you pause, or is this basically a new paradigm where the artificial intelligence and the whole idea of productivity, that you're buying it?
Well, there are several things. First of all, last couple of years, inflation fell without growth slowing down sharply, in spite of the Fed tightening rates. In my view, not because of what the Fed does that pushed inflation lower. We got lucky because there were 3 negative aggregate supply shocks post-COVID that led to lower growth and higher inflation, and they were reversed. The impact of COVID on labor supply and production of goods and services, the impact of the Russian invasion of Ukraine on commodity prices, and the zero COVID policy of China. These were negative supply shocks that were reducing growth, increasing inflation. Those went away, and that explains why you had still high growth and lower inflation. So it was not the Fed job that did it. It was just we got lucky. And on top of these 3 positive aggregate supply shocks, now we have a 4th one that's actually much bigger and secular. This is the AI revolution, this technology revolution that probably over the next decade, not this year, is going to increase productivity growth, is going to increase potential growth, is going to increase economic welfare, and is going to reduce cost of production. So I think that's what the market is reacting to.
When we take a look at this period from a historical perspective, are we going to say that helicopter money worked? That essentially that was what allowed the U.S. to act in a very different manner economically to the rest of the world?
I'm not sure, because during COVID, we had a very temporary shock that lasted only a few months. And the policy response, both on the monetary side, was going back to QE, 0 policy rates, and we had the fiscal stimulus that by any standard was excessive. And therefore, the resulting inflation we saw in 21, 22 was driven by a policy mistake. I think we did too much, both on the monetary side and the fiscal side, and now we're reversing some of it.
You're sounding so optimism, yet Japan, the UK, Germany, all in recession. We're seeing a lot of stagflation. Do you just view this global growth based off U.S. exceptionalism?
There is an element of U.S. exceptionalism. I wrote recently, actually, an op-ed that was titled Artificial Intelligence versus Human Stupidity. And I point out that on one side, we could be in the best of all times because technology may increase potential growth, productivity, and all those things. But it's more of a U.S. phenomenon so far because most of these innovations are occurring in the U.S. rather than the rest of the world. But on the other side, as in my book Megathreats, I point out there is lots of policy mistakes. And there are negative stagflationary shocks, where there is deglobalization and protectionism, where there is global rivalries that are going to fragment the world economy, where there is global climate change, where there is a recurrent pandemic, high private and public debts, sources of inflation, and so on and so on. So I think that we have two forces. One is positive, it's going to lead to higher growth, lower inflation, good deflation coming from positive supply shocks. And there are the mega threats that are stagflationary. And the question over the next few years is which one of them is going to dominate.
You see,
and it's a mixed bag.
Nouriel, in some of your assessments of each region, you've got the US resilient economy, Europe flirting with stagflation, China continuously declining potential. How concerned are you about the direction of Europe and China currently?
I'm concerned in the sense that actually I'm more concerned about China than Europe. Europe has been in a pretty much stagnation for the last few quarters. The same thing with the United Kingdom. But think of it, given the shock that came from Russia, Ukraine, there could have been a real hard landing. Instead, they've had flat economic activity for the last 4 or 5 quarters. The other problem with Europe, of course, is aging, lack of technological innovation, and things that are more structural. China, I think, is a more serious story because Chinese potential growth used to be, for 3 decades, 10%, then went to 5%. I would say most people now estimate the potential growth for China for the rest of the decade is going to be between 2 to 3%. It's a story not just of aging, it's a story of state capitalism, it's a story of less FDI to China because of geopolitical stuff, a story of less export-led growth because there is protectionism all over the world. Consumer and business sentiment is in a funk, in part because of the policies of Xi Jinping. And finally, consumption is low as a share of GDP, and savings are high because you don't have a social safety net. People have to save for old age, for retirement, if they get sick, if they get unemployed, the migrant workers don't have access to public services. So there are really structural reasons why growth in China is going to be 2-3%. And that's a real shift for the global economy.
Is that a disinflationary shock or an inflationary shock for China to be growing at a much slower pace?
It's disinflationary for China, and we already see it in the data. There's also disinflationary for the world in 2 ways. First way is that essentially China is dumping on global market all this excess capacity. And of course, the Chinese currency weakening means that other currencies are appreciating, and that's also deflationary. And finally, if China is growing less, demand for commodities, everything else equal, will be lower, and part of the global inflation for the last few years has been commodities. So overall, a slowing down China is deflationary for the global economy.
Does that economic malaise risk a more assertive foreign policy coming out of the CCP? Is that what you'd expect?
I'm not sure because they had a very aggressive foreign policy, but I think they've realized right now this kind of a wolf warrior policy doesn't make them friend in Europe or around the world. They have to worry about economic growth. The National People's Congress is right now. They're very insecure. And the reaction to the Taiwanese election has been actually relatively moderate. They could have been much more aggressive. And I think they realize in a situation like this one, escalating tensions with the US is not good for them, it's not good for relations with Europe, and they're taking a slightly more cautious approach. I think they're really starting to worry about the economy, about the stock market, and probably, after the Xi Jinping and Biden meeting last fall, there's been a beginning of something of a thaw. I don't think it's a strategic change. There will be continued strategic competition between US and China. The Cold War is going to be like this, but probably for the next 12 to 24 months, the relationship are not going to escalate in the negative direction because they're worried about their economy.
You mentioned the NPC. Can we see any more stimulus coming out of the Chinese government?
Some people have suggested that they should have much more monetary and fiscal stimulus. Xi Jinping and most of the policymakers are resisting it, in part because there is already too much debt and deficits, and doubling down on credit fuel fixed investment is going to be dangerous. But I think that even Chinese realize that the slowdown of growth is structural, is not cyclical. And if you do more monetary and fiscal stimulus, you increase debt, you have a short-term boost to growth. This is only short-term, and you're creating more debt and leverage and more financial risk down the line. So there will be some stimulus, because without that stimulus, their target of 5% for this year is not going to be achieved. I think potential growth already in China right now is less than 4%, but I see growth this year being closer to 4 rather than 5. There'll be some stimulus because without it, growth becomes on a 3 handle. That's something is politically not acceptable, but not as much stimulus to get you to 5%. So something in between.
More on China a little bit later. Nouriel, this is a pleasure. We're going to continue this conversation. I'm still sort of getting over it that maybe the biggest risk right now for Nouriel is upside risk.
I want to know when the last time was that he was this optimistic. I mean, this is basically...
Well, it's upside for growth, but it's downside for the stock market if that happens.
Well, we'll get to that a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Nikki Haley won her first Republican primary, 62% of the vote in D.C. versus Donald Trump's 33%. The win now brings her total convention delegates to much lower than Trump, who has 244. Now, he is likely to pick up many more in Super Tuesday's vote tomorrow. Amazon's Whole Foods is planning a new small format store for big cities for quick trips. The stores will be between 7,000 and 14,000 square feet. They'll have no buffet bars or meat counters. Amazon signed 5 leases in New York City for the concept. The first one is slated to open by the fall on the Upper East Side. Apple has been hit with a $2 billion fine by the EU over its App Store rules. The EU says Apple abused its dominant market position for the distribution of music streaming apps, preventing users from being sold cheaper deals outside the Apple ecosystem. It's the EU's first fine against Apple and follows a complaint from Spotify. Apple rejected the ruling, claiming regulators failed to uncover credible evidence of consumer harm. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Not a great couple of days for Apple, let's put it that way, on Wall Street either. Dropped from the conviction list over at Goldman to close out last week. Beginning this week, removed from Evercore's tactical outperform list as well. Up next on this programme, a massive week on Capitol Hill, punctuated by President Biden's State of the Union address.
Fundamentally, he needs to speak to people who are unconvinced that he's up to the job and people who are unconvinced that he's done a good job.
That conversation is up next, live from New York City this morning. Good morning.
It's a huge week in politics. Tomorrow, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kayleigh Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting tomorrow. Bloomberg, context changes everything.
2 days of gains and a 15th all-time high. Another record high at the close on Friday, kicking things off this Monday. We're negative by 0.1% on the S&P. Yields are climbing higher by 2 basis points, 420.33. Under surveillance this morning, a massive week on Capitol Hill, punctuated by President Biden's State of the Union address.
Fundamentally, he needs to speak to people who are unconvinced that he's up to the job and people who are unconvinced that he's done a good job. Those are the people he needs to focus on. He needs to treat this thing, and I think he will, not only as a de facto campaign speech, but to show that he's on top of the game and on top of the issues.
Here's the latest this week. President Biden's State of the Union address on Thursday, capping off a busy week on Capitol Hill. Voters in 16 states heading to the polls for Super Tuesday, and Fed Chair Jay Powell giving his annual testimony to Congress on Wednesday and Thursday. Bloomberg's Michael Shepard joins us now from Washington, D.C. Shep, for you, out of all of that, what's top of the pile?
Well, we take it one day at a time here, Jonathan. We're really thinking about what lies ahead. State of the Union will offer an inflection point and a moment for Joe Biden to make his argument to one of the biggest national audiences he would hope to get, and that is in his State of the Union address. But ahead of that, we're going to see a few other things that will bear watching. On Tuesday, we have the Super Tuesday primaries in 15 states in American Samoa. But what we're looking for there is not really the surprise factor. We know that Donald Trump is, odds-on favorite to win in sweeping fashion. What we're looking for is what will Nikki Haley do when it comes to an end on Super Tuesday night when the polls close. And what we're looking for her to do is likely drop out soon after. She has said she will stay in the race through Super Tuesday, but afterward, the math is just not looking to be in her favor.
When it comes to the State of the Union, what do you think Biden needs to say about the economy? Because the polls over the weekend, the Wall Street Journal saying 31% of voters say the economy has gotten better. This is an uptick, but they're still not giving Biden the credit when it comes to that. How does he hammer home this message?
Annmarie, that's going to be one of the biggest jobs he has on Thursday night, to reinforce that, the tide is turning economically. We've seen the pace of inflation slow significantly. Hiring is continuing. We're not seeing any signs of the soft landing that people have been talking about. Instead, the economy has kept going and going. And so that is a good news case he can present to the public. The challenge that the president faces is that, many voters, including those surveyed in the 7 swing states we polled, find that he may be too old for the job. The concerns about his age come up again and again. And it's not just what he says about the economy and about the state of the nation and about his priorities. It's how he says it, too.
Yep, he needs to be compelling, is what the Washington Post says. You mentioned Benny Gantz meeting with the vice president today. How important is him to potentially ink this ceasefire in Gaza before his address on Thursday?
Well, it would be a huge boost to his argument politically here in the U.S. Obviously, the clock is ticking. Given the desperate situation on the ground in Gaza, where hunger and health conditions are so dire, we saw the U.S. dropping air supplies over the weekend there in a signal of how desperate things are and how really significant the situation is. But for Biden to be able to say, look, we have a deal, we will be able to get medicine and food into the territory for at least 6 weeks and hopefully reach some sort of longer-term agreement. But that is the time pressure is also with Ramadan coming up. That begins on March 10th. And then politically, as I said, at home, Biden is under pressure from Democrats to do something to stop the violence and stop the bloodshed there.
Big time, and has been for the last few months. Michael, appreciate the update. Michael Shepard there, down in Washington, D.C. With us around a table through much of the next hour, Nouriel Roubini. Nouriel, I want to talk about something you've said, which is the biggest election year in history. A lot of people have said that line as well. Is that just purely about the numbers or the significance of the votes that take place this year?
It's not just the numbers, but I would say of all the elections, the most important one actually is the one in the United States, the one that could give us more of policy surprises. India, Modi is going to do well. European parliamentary election, probably vote towards populists of the right, but that's expected as a protest vote. I would say of all these elections, it's 4 billion people, but I'd say the one that actually is going to have a global economic and market impact is going to be the U.S. election.
Do you have a sense of what that impact would look like, depending on who wins in the United States?
Well, I think that geopolitically, many people worry that the policies of Trump, if re-elected on foreign policy, will be very different from Biden. I don't actually think so, because both Democrats and Republicans are tough on China. They're going to remain tough on China. On the issue of the Middle East, Trump, like Biden, realized that eventually normalization between Israel and the Arab states implies something of a two-state solution. He was himself when he was in power. Trump's sort of in favor of it. He's going to play hardball with the Europeans on Russia, Ukraine, but I don't think he's going to give up on Ukraine and give it to the Russians, because he wants to be tough on China. Now he's going to deter China and Taiwan if you're soft. So there'll be frictions, and he wants the Europeans to spend more. So I don't worry as much about foreign policy. I worry about, of course, some of the domestic policy. I think that on economic policy, that's a bigger risk to growth and market. He has said, Trump, is going to impose a 10% tariff on all imports from everywhere around the world. Today, the average tariff rate in the U.S. is about 2%. And he said, in the case of China, it could increase tariffs to 30, 40, even 50, 60%. So you're going to have a trade war, not just with China, but also with your friends, allies in Europe, Japan, Korea, and so on. So economically, I think that's a big risk for the economy, for growth, for inflation, and for the market. It's something that I think people have not yet priced in. Second, I think that while there are large fiscal deficits between when Democrats are in power and Republican, he essentially has said he wants to renew completely all the tax cuts that were passed during his first administration. It's another $1.5 trillion, as opposed to just letting them expire. If you do that, you're not going to cut spending. And he said, I don't want to touch entitlement. You'll have another big fiscal deficit. And last year, market started to worry about U.S. fiscal deficit becoming unsustainable. That's when the 5-year Treasury yield went to 5%. So the combination of those two things actually can be really bad for the economy and the market. You could have yields going higher, stock market falling, inflation rising, protectionism. So that's the economic risk.
When it comes to the tariffs, though, you said no one's pricing them in. When would they have to start actually thinking about that?
Well, they don't know yet whether it's going to win or not. The polls say he's ahead, but I think the economy, we know, is doing quite well. Of course, Biden has an issue of messaging, but, strong growth, low unemployment rate, job creation, falling inflation rate, stock market all-time highs, so by any standard. And I think that some of the polls are also biased by partisanship. If you're a Republican, you don't like Biden, you're cranky because of that rather than being cranky about the economy. So there is this bias as well. So I would say for now, we don't know who's going to win. And of course, if he's going to win, then he has to pass these actions. Some of them may require legislation, some of them may be done by executive order. And people are not yet concentrating on it. He's saying it, they think maybe it's not going to happen. But I think the biggest risk next year, if he's elected, is a trade war and unsustainable fiscal deficits. Those are really big issues.
People just aren't ready to talk about it yet. And so, Nouriel, stick with us. Nouriel Roubini with us for the next 30 minutes or so. Coming up a little bit later on the programme, Torsten Slok of Apollo on that big call for 2024. He's looking for no rate cuts this year. Coming up next, China breaking 30 years of tradition at the National People's Congress. That conversation with Undercurrent up next. I started the programme this morning with this stat. I think it's worth repeating. 16 weeks out of the last 18 on the S&P 500 positive. Jim Reed, Deutsche Bank, that's the longest run since 1971. He takes it one step further. If we make it 17 out of 19 this week, it will be for the first time since 1964. This rally has been absolutely phenomenal. Equity futures right now pulling back just a touch. We're down by 0.1% on the S&P, just about positive on the Nasdaq by 0.05%. Bramo, more all-time highs at a close on Friday to kick off with the same thing this Monday morning.
Yeah, 15 record highs so far in 2024. And what I find interesting is normally when you get a rally like this, you get all the pessimists coming out and saying it's unsustainable. Things have gotten a little over their skis. Price to equity ratios look off kilter. And instead, you're getting upgrades. You're getting people saying we're not seeing a lot of holes to the thesis that's driving this incredible run.
I'd go one step further. David Kostin, Goldman, it's different this time. Yeah. It's different this time.
This is really the most dangerous 4 words in finance, and a lot of people will say that, but he's not alone. It's just that everyone's couching it differently because ultimately the drivers of this, the big tech behemoths, have the earnings, have the promise, and have the transformation of the economy that a lot of people are looking for.
And these are the new price targets on the street in the last week or so, the last 2 weeks. Goldman 5,200, Piper Sandler 5,250, Barclays 5,300, UBS 5,400. Bank of America, Savita Subramaniam joining them over the weekend, 5,400, the very top of the pile. And now the most bullish on the street. And you made this point. It's only 5% upside from here. We're chasing this market as it keeps on climbing.
I like that you say we're chasing this market, people realizing that there's more under the hood. Here are the key questions, though. We were talking about this with Lori Calvasino, who has a different range and hasn't upgraded yet, but could to 54 or 5,500. It really has to do with the economy. It is the black box of whether we are accelerating or whether we are decelerating. And we have gotten it wrong again and again as people were looking for a slowdown. It just has not transpired.
Speaking of getting it wrong, let's just turn to the bond market. Getting it wrong about 4 different ways already this year. It's only the start of March. The 2-year this time last week, closed at about 470 on a 2-year, just north of that level for the first time this year. Fell all the way back down to 455 this morning, up a single basis point, Lisa, 454.77. So the low of the year was 4.1. That was January. The high of the year was 4.7. That was only a week ago, and we're back down to about 455 now.
I'm old enough to remember when we were pricing in 6 rate cuts for this year. Right now, we're pricing in far fewer than that, fewer than 4, about 3, in line with what the Fed is expecting. What if Torsten Slok is right, though? What if the Fed does not cut rates at all this year? Is that bearish for stocks, or is that bullish, considering that it would be doing so on the heels of a lot of growth? I don't know the answer to that. I don't think anyone else does either.
You'd think it would be bullish for the dollar, that's for sure. The euro against the dollar at the moment, 108.51. That currency pair positive 0.1%. We will get an ECB meeting on Thursday, which, as we've said a few times already this morning, just doesn't feel quite right that that's happening so early in the month. But anyway, under surveillance this morning, a busy week of eco data and Fed speak on deck. The highlights, Fed Chair Jay Powell giving his annual testimony on Capitol Hill Wednesday and Thursday in Europe. An ECB rate decision on Thursday. Christine Lagarde widely expected to keep rates on hold for a 4th straight meeting. Then on Friday, the big one, Payrolls Friday just around the corner. Nouriel, you've been great to stay with us for so long. I want your view on the Torsten Slok call over at Apollo. The no rate cut call for 2024. You've alluded to some of this. You've touched on it a bit already. But How realistic do you think that is? No cuts in 2024?
Maybe no cuts may not be realistic, but I would say that the possibility that the Fed's going to cut rates later and even less than 3 times as they have projected is a meaningful possibility. Growth is well above potential. The Atlanta Fed, no cuts for first quarter is around 3%. The economy, because of AI and technology, might keep on growing. And that may imply that the inflation is going to remain sticky. And I think that's the biggest, actually, potential market surprise. Because last year, as you remember, when people had to revise their expectation about Fed cuts in the second half of the year, you had a 10% correction. Now, this year, in spite of the Fed signaling we're not going to cut as soon as markets want, the market has gone up because, of course, there is the tech story. But suppose that the inflation remains sticky, closer to 3%, and then people say it's not going to be 3, it's going to be 2, it's going to be 1, maybe 0. I think that on net, in spite of stronger growth, the impact of high rates for longer is going to be negative. It's going to be a correction, not going to be a bear market, but there will be a correction, like last year. That will be my guess.
I'm still trying to wrap my head around an optimistic Nouriel Roubini, because this is about as optimistic as I've ever seen you. So are you basically saying that the worst case scenario, just to sort of cap it off, the worst case scenario is that the economy runs too hot, and that potentially, with hotter than expected inflation, it would cause the Fed policy to go a little bit longer than previously expected, which will cause a slight downdraft, but nothing to really write home about. Is that basically the worst case scenario from Nouriel Roubini right now?
For the markets, yes. For the markets, I would say soft landing would imply, of course, that the markets stay high, can go higher. What can lead to a correction today? More than a bumpy landing with a short and shallow recession, it's going to be a no landing. But that's for the US. If you look at the rest of the world, Europe and the UK is mediocre. China is mediocre. Many emerging markets are fragile. Japan is rallying in the stock market, but the economy is just okay. So the rest of the world doesn't look great. I think it's a US story.
Lisa was listening to expand this list, Nouriel. She's got a list of things to worry about. She was hoping that you'd give us some help this morning.
This is
Isn't
not
that
helpful.
right?
This is not helpful.
Not helping at all.
No, I don't have anything extra to add to it.
As I said, I wrote an entire book titled Mega Threats, where I say that
That's why I was
over the
hopeful.
next decade, there'll be lots of stuff that can go wrong.
It's true.
And there'll be serious stagflationary forces in the global economy. So those are medium-term kind of trends. In the short run, the U.S. economy is doing well. The technology story is the right. But as I said, whether it's going to be artificial intelligence essentially rescuing us as opposed to human stupidity having to do the wrong policies, there are plenty of wrong policies. I think it'll be the battle between the two. And there are lots of headwinds in terms of stagflationary shocks to the world over the next decade.
Let's talk about something that could go right down in D.C. US lawmakers reaching a deal to avoid an imminent shutdown and fund parts of the government through the end of September. House and Senate leaders will vote on the matter in coming days. The deal leaving parts of the government, including defence and homeland security, facing a March 23 shutdown. That deal will be tougher to negotiate, given ongoing disputes, AMH, over the US-Mexico border.
Yeah, that's right. So they've avoided the first deadline for a government shutdown almost. We can all say with confidence they're likely not going to shut down. Falls short of some conservative demands, Jonathan, but there's nothing in here that's offensive to, say, a moderate or even some on the hard right or hard left for voting for this. The issue is going to be when they try to hammer out this defense deal and also funding Homeland Security, because they want the Senate also to take up their bill to impeach Alejandro Mayorkas. So this is what we're dealing with as we look to the end of the March. It's going to be a much tougher negotiation.
I think we're all super happy that we can move past some of this and talk about other things. Let's talk about this. China set to unveil its 2024 economic targets at the National People's Congress tomorrow. The party expected to announce a growth target of 5%. Officials hoping for an economic recovery as the nation grapples with deflation, an ongoing property crisis, mounting debt, and a flight to foreign capital. Economists at JP Morgan expecting policy to stay growth-friendly, but warning not to expect a, quote, bazooka-type stimulus. Enda Curran joins us now to talk more about this. Enda, can we just talk about tradition? The last 30 years, what would typically happen before this and what isn't happening now? How big a change is this?
It's a big change. So the set piece of the NPC every year, John, was a press conference by the Premier, a rare opportunity for the press to put some questions to one of China's top leaders and, of course, for the rest of the world to hear from their own mouth what the outlook for China is. Well, this year that press conference has been cancelled, and the Chinese government have made clear that they're also not going to run this annual press conference during the remainder of this current government's term either. So you would have to say, from the outside looking in, that is a curious step. You could almost say a retrograde step for a government that's already under a lot of scrutiny when it comes to transparency from overseas investors. There's a domestic angle on it as well, by the way. You have some China watchers making the point that it's another example of the Premier losing some of his status and all the power going to the General Secretary, President Xi Jinping. So no press conference from the Premier this year. I think it does leave a bit of a hole in the annual in China's economic calendar.
Speaking of transparency, the past few months we saw China go through the shortest term for a foreign minister, the shortest term for a defense minister. Any update on some of these key political positions?
Well, we know that some of them have been more or less shuffled out of their positions by now. We'll get more detail on all of the personnel moves this week, Annmarie. Of course, on the Chinese side, the officials there say that it's not unusual for people to move in and out of government roles. That happens in other governments right around the world. But of course, as you say, in particular with China, we had the defence minister and the foreign minister both having high-profile roles on the global stage, up until a point whereby they no longer were prominent and, in fact, were nowhere to be seen. And that, of course, speaks to this whole idea about the black box element when it comes to looking at China at the moment. A lot of investors and outsiders wondering about what direction the government is taking. A lot of focus on the transparency of the government these days, whether it's economic data or whether it comes to personnel movements in the government. And this week that's why this week is so important. We'll get the roadmap for the government, for the economy for the year ahead. And as you say, we'll get some detail on the personnel moves, which will be very closely scrutinised indeed by China watchers.
And just before we go, what kind of growth can we expect from China this year?
Look, as you say, they're going to expect it to come in around 5%. That's going to be hard given the base effect. Look out for this commentary around high-quality growth, John. That's the key for this year's MPC. Look for what they're talking about. Technology, innovation and industrial policy. Those are the key sectors to keep an eye on.
And thank you, sir. And Karen, down in Washington, D.C. on the latest with China. Just a final word now from Nouriel Rabini of Rabini Macro Associates. Nouriel, if growth in China drops to 2 to 3%, how will we know? Are they going to tell us?
Probably they're going to massage the data, as they always do. But I think there are other indicators of economic activity of China that cannot be manipulated.
What would you look to?
I would look at their PMIs. They're usually a good indicator of what's happening. So sometimes they say 5% growth, but the PMIs right now falling even below 50%. That implies the economy is slowing down, if not starting to contract. So there are ways to gauge what the economy is doing. They cannot lie about everything. Of course, sometimes when some numbers like youth unemployment are bad, you
just stop reporting
don't report.
But how much?
Or like when economy is bad, you don't have the premier having the press conference. But it's actually self-defeating because right now China is becoming more and more uninvestable. It's in part because we don't have data, there's no transparency, there's more opaqueness, and then people are leaving further, both the domestic and foreign investors. So they shoot themselves in the foot thinking that opaqueness is going to help them. It doesn't help them.
Do we have some data in the form of oil prices, iron ore, copper, that have all been much lower than people expected?
They have, but some of them are driven by demand factors. Other of them are driven by supply. For example, in the case of energy prices overall, there's been a significant increase in productive capacity, even of fossil fuels, even in the United States, or LNG and things of that sort. So I would say that historically, movements of energy price or commodity were driven more by demand and reflecting what's happening to global growth or Chinese. But right now, there's also a meaningful shift in supply. Even with the green metals, people said demand is going to grow because of the green revolution. Supply is going to be constrained by regulation. But there's tons of nickel, lithium, cobalt around the world, and some of these mines are coming. And that's why sometimes you see 50% drops in the price of green metals. It's supply-driven as opposed to demand-driven.
A lot of this has been way too constructive. Before you go, just not to disappoint Bramo, this book, Mega Threats, that came out a number of years ago now, time flies. Can you tell us the number one mega threat that you think hasn't been talked about enough since you published that book?
I would say that people are still underestimating the impact over time of global rivalries on the global economy. So far, the impact has been modest, but I see a world in which the conflicts between a number of revisionist powers, China, Russia, Iran, North Korea, and US, Europe, the West, is going to become a colder war. We already have actually two hot wars, one Russia-Ukraine, the other one, of course, Israel and Hamas, but it's just a proxy for Israel and Iran. And the Cold War between US and China this year may not escalate, but over the medium term, I think that the Cold War is going to get colder. And there's a risk within this decade that eventually the conflict on Taiwan is going to come to something of a boil. Because, Xi Jinping wants to pass to history as the man that reunited mainland with Taiwan. So something's going to happen. And so far, I think markets have been calm because these risks have not been materializing or their economic impact has been modest. But I would say over the next few years, geopolitical things are going to get worse.
Nouriel, it's good to see you. Great to catch up.
Great seeing you.
Thank you, sir. The brilliant, the wonderful Nouriel Roubini of Roubini Macro Associates. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Here is Danny Berger. Hey, Danny.
Hey, John. Boeing confirmed it is in talks to buy former division Spirit Aerosystems. The part supplier is at the center of the issues affecting the 737 MAX jet. Boeing saying in a statement, quote, "We believe the integration of Boeing and Spirit Aerosystems manufacturing operations would further strengthen aviation safety, improve quality, and serve the interests of our customers, employees, and shareholders." Shares in Macy's higher pre-market. Investors boosted a takeover bid for the retailer. Arc House Management and Brigade Capital Management increased their offer by 14%. It's now $24 a share. It was $21. That's a 33% premium to the close on Friday. Macy's rejected the bid earlier in January, instead unveiling a restructuring plan where it will close a third of its namesake locations and grow its Bloomingdale's and Bluemercury brands. California and parts of the U.S. West Coast are set to face more dangerous wind gusts and deep snow to start the week, after already days of winter weather blanketed the area with up to as much as 8 feet of snow. The deadly conditions forced road closures between California and Nevada. Amtrak canceled trains across the region. That's your Bloomberg brief. John.
Hey, Danny, thank you. Up next on this program, making the case for no rate cuts.
Very reasonable case for zero cuts. Have a Fed pivoting, doing a dovish pivot into 3.7% unemployment with GDP continuing to be strong is really pretty remarkable.
Torsten Slok, Apollo, says no rate cuts in 2024. That conversation up next. Live from New York City, equities pulling back by 0.1% on the S&P. Under surveillance this morning, making the case for no rate cuts.
Very reasonable case for zero cuts. Real wages are climbing, where inflation broadly is falling, and you're starting to see nominal wage gains really come higher and higher and higher. So the concurrence of that, where you have a Fed pivoting, doing a dovish pivot into 3.7% unemployment with GDP continuing to be strong is really pretty remarkable.
Here's the latest. Investors looking to Fed Chair Jay Powell testimony on Capitol Hill this week for more clues on the Fed's path forward as rate cut expectations are pushed back to summer. Apollo's Torsten Slok going a step further, writing this. The reality is that the US economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December. As a result, the Fed will not cut rates this year, and rates are going to stay higher for longer. Torsten, I'm pleased to say, is with us around the table in New York. Torsten, good morning to you.
Good morning.
OK, big change. Let's talk about why and what underpins it. You've put out 10 reasons in your most recent note. What's the number one reason for you?
I would say the change that we have had since the December FOMC meeting in financial conditions is really dramatic. Think about it. The stock market hitting all-time highs, credit spreads in IG and high yield continuously tightening. January and February saw the biggest credit issuance in the history of going back to January and February. And you also at the same time have IPO activity picking up, M&A activity picking up. So the tailwind that's coming from easy financial conditions is really not surprising that the employment report in January was so strong. It's not surprising that inflation started picking up in January. This is not statistical quirks. This is really a true tailwind coming from easy financial conditions.
So the obvious follow-up question to this then is that if we begin to believe you, does it make rate cuts more likely again?
Well, the issue is, of course, that we need then financial conditions to begin to tighten. And given that's not happening every day, including today, you're seeing more and more signs of easing. And on top of that, also, as a second issue is you're still seeing short-term inflation expectations in break-evens. 1- and 2-year break-evens continue to march higher and higher. How can the Fed cut when inflation expectations are continuing to march higher. It really is a major challenge for the Fed here, where you both have a tailwind as a result of their own actions, but also with the market now saying that inflation expectations are continuously drifting higher.
Do you think this means, given the fact that you are seeing two-year inflation expectations surge to such a degree, that this means that the Fed's rate policy right now is not restrictive and that it's actually not causing any kind of disinflationary impulse?
Well, that opens up the very important debate about our star and where are we relative to the long run rate. So if we in the long run have to have the Fed funds rate at 2.5, we are absolutely restrictive. But what's most important about this discussion is that the transmission mechanism of monetary policy is hitting very unevenly. It's particularly hitting companies with high leverage. It's hitting households with a lot of leverage. So that's why those entities in the private sector, households, firms, even some regional banks that have a lot of leverage, that are very vulnerable to interest rates staying high, they are certainly seeing the negative impact. But the rest at the macro level, you see this in the employment report, you see this in jobless claims across the board. The tailwind from financial conditions easing so much just continues to be really strong.
You had a chart over the weekend that I thought was really fascinating about why this economy has been so rate insensitive, in particular U.S. companies, large caps, saying that the larger companies generally have fixed rate debt. They termed out their debt. And this is the key reason why Fed hikes are having a more limited impact on the economy. They account for a greater amount of the hiring. If that's the case, could you see a scenario where even if the Fed keeps rates at 5.5%, you don't see equity markets go down? They keep rallying, at least when it comes to large caps.
Exactly, because the equity market is dominated by large firms. And exactly as you're saying, Lisa, we have a situation where, as you know, 90% of household debt is fixed rate. And when it comes to corporates, it's slightly more complicated. But you generally have, for S&P 500 companies, they are generally fixed rate. And you have Russell 2000 companies are generally floating rate. So that does mean that there are companies, in particular those with a lot of leverage, those with low coverage ratios, low with relatively weak cash flows. For example, venture capital, tech, growth, in particular venture capital, where you by definition buy companies that have no earnings. Of course, they're going to struggle if the cost of capital stays high. So yes, the transmission mechanism is working as the textbook would have predicted. It's just only working on a certain segment, namely those firms and those entities that have high levels of debt.
Let's go back 12 months. Scene. We're sitting around a table. It's a morning like this one. I get something in my inbox. It's an email from you, and the title of it reads as the following: From no landing to hard landing. The hard landing call from a year ago from you. What happened, and why is this economy turning out to be so difficult to read? Why do we seem to flip from one narrative to the other, back and forth, month after month?
Yeah, no, obviously we went into last year, everyone expecting a recession. We went into this year, everyone expecting 6-7 cuts. And of course, the economy just continues to turn out to be stronger. I think that there's a number of things, namely that when we had the situation in March in the banking sector, it was rescued by the Fed much faster than really anyone expected. And that meant that the impact on the economy turned out to be smaller. Normally, a crisis in the banking sector does mean a crisis in the economy. But given that this was done in a way where the Fed managed to keep this relatively contained, it turned out to be more light. And at the same time, the AI story rolling over us over the last several quarters, and still today, continuously giving a huge tailwind. All this just argues today for the Fed looking at that and saying, well, AI and higher productivity, if we do get it, it's going to mean less inflation. And on top of that, we will ultimately, of course, have still strong growth coming, supporting us.
Let's get into that last point. I think it's important because a year ago, the AI story felt more like a market story than it did an economic one. How quickly has it become an economic story?
Yeah, well, so far the gains, we are seeing some signs of productivity growing, but of course all the gains and all the story really is mainly in financial markets. So that's why the wealth effect, in particular on households and retail, who are holding a lot, of course, of Magnificent Seven stocks, they have, of course, been quite significant. So you are seeing especially the wealth effect and, of course, financial conditions being generally easy has been very helpful for GDP growth, not only for consumption, but also for capex. So the AI story has certainly come in and taken and sucked a lot of oxygen out of the room in terms of all the other things that were going on. And this continues to be still a very important tailwind to everything that's going on.
How long can we keep this divergence going, where the large caps continue to do just fine, and then you have the small caps that are getting blown out of the water, that are going bankrupt, that are really struggling? At what point does that sort of become untenable and there has to be a resolution?
Yeah, no, this is really, really important because you're seeing the same thing for consumers. For households, of course, households who own assets, households who own fixed income, they see more cash flows, they see assets going up, whereas households who have more debt, households who don't own fixed income, of course, are more challenged in this environment with interest rates staying higher for longer. So it's both when it comes to the household sector and also to firms, that those who are more vulnerable to interest rates staying higher for longer, this will continue. And again, this particular hits growth, tech, venture capital firms, some parts of healthcare, some firms that have a lot of debt, a low coverage ratio, and essentially no earnings. They are, of course, going to be challenged now that interest rates will be staying higher for longer.
Torsten, got to finish with this. So new base case, facts have changed, your views changed. Base case now is no cuts this year in 2024. How many January-like data points do I need to see before I get a new email that says something like there's another rate hike coming?
So this is a really important debate at the moment because this is certainly the pain trade. No one is prepared for more rate hikes coming. But I would also say, John, in your world, think about it. The tips market is saying that inflation is a problem, But at the same time, SOFR futures are saying, no, rate cuts are coming. That's inconsistent. You can't have that. You both have a lot of rate cuts. And at the same time, tips markets are signaling that the inflation is going to remain a problem. So I would say the next data point obviously is, well, first of all, of course, Jay Powell on Wednesday. Then we have on Friday non-farm payrolls, where my Bloomberg screen tells me 200,000 jobs in the month of February. That's not bad. That's not a slowdown. So it really does boil down to that we are simply not slowing down. Where is the slowdown that we all had expected for so long, including myself and the consensus and the Fed? Remember, the Fed last year said we expect a recession in the forecast, and they have taken that out. So I think if we were wrong and waiting for Godot for so long, maybe Godot will not arrive in the next quarter or two either.
Torsten, really thoughtful piece. Always enjoy catching up with you, sir. Thank you. Torsten Slok there of Apollo on why this Federal Reserve won't cut rates in 2024. Coming up in the next hour, we'll continue this conversation. We'll catch up with Darryl Cronk of Wells Fargo, Ed Mills of Raymond James, Seth Carpenter of Morgan Stanley, and a whole lot more. From New York City, this is Bloomberg.
I think we have another troubling inflation report that's going to come in March.
Enough people out there are spending that it creates inflationary pressure for everyone.
We're out of the world where inflation stays in that 2% lane.
Inflation falling to target is currently underappreciated by markets.
Inflation is still slowing, and I think it's probably slowing more than the consensus thinks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now, and what an optimistic bunch we've got. Torsten Slok of Apollo already on the program earlier on this morning saying things are so good the Fed won't cut in 2024. Sticky inflation may well be an issue. Nouriel Roubini of Roubini Macro Associates, Nouriel Roubini, saying the biggest risk for this economy in the near term, Bramo, is upside risk. That is not typically the kind of thing you'd expect Nouriel Roubini to tell you.
He didn't add to my list of worries. If anything, my only worry now is that there is no pessimism anywhere, that it seems like everybody just feels like the upside is the only case that can exist. The fact that even if we have his worst case scenario of upside risk to growth, the downside for stocks would be a mild correction, nothing that insignificant. I mean, this is from the Uber bear of Wall Street.
And then we get Chairman Powell for his assessment a little bit later. I wouldn't call him the Uber bear of Wall Street, but the outlook for him, Bloomberg's Anna Wong, Powell will signal he's in no hurry. Mike Gapin over at Bank of America, Powell needs greater confidence. Citi's Andrew Hollenhorst, the Fed needs more data. What kind of Chairman Powell is coming up on Capitol Hill this week?
Well, if you believe what Torsten Slok is saying about no rate cuts, he is going to face some serious pressure from Democratic lawmakers like Elizabeth Warren, who said in January he already should be cutting because they were so concerned about what this means for lower-end consumers and what it means for people that are dealing with higher housing costs and higher rents. So he's going to get a ton of pushback from Democratic lawmakers if he's saying that, well, we're waiting for the data. And they're saying, well, the data is already showing that you should be cutting.
Well, he can point to the labour market. 200K is the estimate for Friday. 200K, the previous number 353. Unemployment at 3.7%.
If anyone looks at those data points and say you need to cut right now, then they're looking at a different set of dashboard indicators than a lot of people are in this market. There is a real question, and Torsten Slok was alluding to this just in terms of who these rates hurt the most. How the sort of compositional aspects of keeping rates higher for longer really do shape, maybe not things when it comes to the magnificent 6 or 5 or 4, whatever you want to say, but when it comes to the political sphere and just how people are really messaging.
Yeah, let's be blunt. If you're a saver, great times.
Right.
If you're a borrower, not so great.
And basically, that's what we've seen with, some of the auto loans absolutely tanking because people can't afford to spend 8, 9, 10% on a vehicle that also is much higher than it has been in the past.
Credit card delinquencies as well, something we talked about in this programme over the last few weeks. Let's set the stage for you. Equity markets on the S&P 500 pulling back by 0.2%, just a touch lower here. Bond markets, yields higher by almost 3 basis points now, 420.91 on a 10-year. Coming up this hour, Darryl Cronk of Wells Fargo on why he thinks the market view is too rosy. Ed Mills of Raymond James previewing Super Tuesday. And Morgan Stanley's Seth Carpenter weighing in on the Fed's road ahead. We begin this hour with our top story. Stocks setting a record high on Friday ahead of a monster week on Wall Street, including the jobs report and a double dose from Chairman Powell. But Darryl Cronk of Wells Fargo thinks investors need to take a step back, saying this: the S&P remains near a recent record high, even with the probability of Fed rate cuts this year falling from 5 to 6 down to the current expected 3 over the last 2 months. Lighten up on the top 12 outperformers, including tech. The market view is too rosy. Darryl joins us now for more. Darryl, let's get into that. Lighten up where? We're talking about the Nvidias of this world, the top performers of the last 12 months?
Yeah, I think you can certainly lighten up your equity exposure overall. I mean, I would take it first from small cap, which has been, a relative underperformer, battered and bruised. But I think you do have to lighten up. If you've enjoyed 24% return over the last 4 months, which is what you've gotten, November, December, January, February, 4 months, right? That is impressive. You'd be wise to take a little profit there. To the conversation you were having earlier, remember and recall sage words, wisdom says bull markets die in euphoria, right? To the point, there is no downside that anybody sees at this point. We are starting to approach a little bit of euphoria here, and I think you have to set that context correctly.
Let's get into that word, euphoria. So Savita Subramaniam's come out over at Bank of America. She's gone to 5,400 from 5K. She says any signs of euphoria are thematic and secular. So we're talking about AI, Nvidia, we're talking about GLP-1s, we're talking about Novo Nordisk. Outside of that, where are you seeing what you would describe as euphoria?
I think you're seeing it in, you're definitely seeing it in technology, you're definitely seeing it in consumer discretionary, you're definitely seeing it in comm services, all the leaders that have continued to lead. For markets to really make that next leg higher, you've got to have 3 things happen, right? You've got to have breadth widen out, right? Narrow markets die painful deaths, right? I mean, 2023 was the narrowest market only to 2007. We know what happened in 2008, right? And if you go back and look at other narrow markets, 2020, 1999, 2021. Remember 2021 to 2022, what happened in 22? Big negative returns. What happened in 1999, in 2000, right? So narrow markets don't sustain that leadership. History teaches you that lesson over and over again. So you need breadth to widen out, you need earnings to participate, better fourth quarter numbers, right? We'll take the earnings growth, but think about it this way. If companies, even large cap companies, if their wages are still growing 4, 5, 6%, right? But their top line, we just saw the total sales number grow at 3, let's call it. I can't have my biggest expense line as a company CEO or CFO growing at 4 or 5% and my top line growing at 3 without starting to lay people off, without starting to roll the economy over in that sense.
So you can't talk about 2007 and sort of some of these others in 1999 without really giving some sort of size and scope of what you're expecting. Is lightening up simply because you see a rotation in leadership or because you see some serious downside ahead?
I think you could, so let me put it this way. If you take forward multiples today at 22 times, right, you're in the 90 to 95th percentile of the last 30 years of historical multiples and valuations, right? When you spin the clock forward, when you get into above 90 percentile, you spin the clock forward 12 months, your average annual return is 0%, right? So I think you can probably crest here as earnings catch up, which is often what happens. You pull prices forward, prices reset, and then earnings have to catch up. But let's be clear, they have to catch up, right? I mean, the consensus is still at 243 for earnings estimates today. We'll finish the year probably for 2023, we got 97% of earnings in at maybe let's call it 220, 222, 223, somewhere in there. That's a big jump for this next year. It has to deliver, right? The micro has to deliver. It's no longer about the macro.
How much are you really counting on the Fed to cut rates by 3 or 4 times this year to really keep things on an even keel, if not necessarily going gangbusters, at least not declining materially?
I tend to agree with where the consensus is starting to go to. I think the Fed's going to have a hard time cutting rates the amount of times they want to. What people forget, think about this. So we know we've had goods-based disinflation, right? The goods sector has come down hard. Services, which is 70% of this U.S. economy, you know what the inflation rate is of the services piece of the economy today? 5%, right? Is 5% anywhere close to where the Fed wants it to be? That is way too high and too hot. You couple that with the wage inflation we just talked about, right? And you couple that with also probably losing the tailwind of goods deflation. I think inflation does stay higher. And look, if you look at the bond market, so I went back and looked over the weekend, and I was trying to show me a period of time where the 10-year Treasury was increasing. Remember, it went up 34 basis points in the month of February. The 10-year Treasury was increasing 3 months before the Fed cut interest rates, and I couldn't find one, right? So rates are still climbing, inching higher, when if the Fed's going to deliver on this May-June timeframe, they should be about facing it coming back down.
Do you then agree with Torsten Slok of Apollo that there's a real chance that the Fed is not going to cut rates this year at all, and that markets can still stay pretty much in an even keel?
I think the Fed desperately wants to cut rates. I don't know whether the data is going to allow them to as many times. I think we're going to have to look at our own estimates, right? But if we don't get, to your very question, if we don't get rate cuts, yes, then I think markets have to reprice from here, because I think the consensus is still too strong that rate cuts cometh, right? And without that tailwind, I think you're going to have a hard time with equities being at the valuations that
Can we just get to the lesson of the last 2 months, though? Because we have gone from 6 to 7 all the way back down to 3, and we've done that painlessly.
Painlessly.
How have we done that?
I think what you're doing is you're papering over what the great lesson I think that we've learned here over the last couple of years is the amount of fiscal stimulus, right? When you look at it's 9% of the GDP, right, is the budget deficit we're running, has just papered over and papered through a lot of what's happening, right? I do think you are going to start seeing markets pay attention if you come down below 3 rate cuts. So if some of the narrative that you're getting today, John, continues in that direction, i.e., 1 or 2 rate cuts or 0 rate cuts, I think markets will start to pay attention to
I think this is a challenge for me because, Lisa, we repriced from 4.1 to 4.7 on a 2-year. We priced out 6 to 7 cuts, and we're pricing in, say, 3 right now. And this equity market carried on rallying. And we'd had this same conversation at the start of the year. Without a doubt, overwhelming consensus would have been we cannot do that without this equity market selling off, and it didn't.
Well, and part of the reason why is because all of the biggest companies, to Torsten's point, have termed out their debt, have fixed rate debt. They've locked in lower rates. They're not necessarily that sensitive to higher rates anyway. And guess what? They're making their earnings continue to rise on the heels of the strength that is not really allowing the Fed to cut rates as quickly as they'd like.
Darryl, before you go, you're not exactly screaming go to cash. There are sectors you do like on this S&P 500. What do you like right now?
Which is the theme of widening the breadth out, right? So I would phrase it this way. Materials and energy on value, on kind of a deeper value and valuation opportunity. And then we still like industrials and healthcare, which have been really strong relative outperformers of late. So I think you can end with that. And I would just, to Lisa and your conversation, I think the great question we have to ask and reverse engineer is, if 5.5% Fed funds slows nothing, right? It didn't slow business, it didn't slow consumer, right? Hasn't slowed government spending, right? Why cut, right? What's the thesis to cut if 5.5% really doesn't become friction in the economy?
It's exactly what Torsten is asking right now. Darryl, it's good to see you.
You too,
Great to
John.
catch up. Darryl Cronk there of Wells Fargo. Torsten Slok basically said break-even rates, what did he say on the 2-year maturity, starting to climb higher. Equities are at all-time highs. To your point, 10-year Treasury yields are rising. It's an odd time with that in isolation, just looking at that specifically, for a Federal Reserve to be cutting interest rates.
Where's the confidence that they're actually going to get down to 2% in any of the data that you just listed?
Not much right now. They need more confidence. Isn't that actually what they're telling us, though? Because maybe a little space to push back would be Darryl saying, they want to cut interest rates right now. They look pretty hesitant to cut interest rates based on the communication we've had.
Which is the reason why it's now plausible that they will not be able to cut rates at all this year. Because if the data continues at this level, then how can they answer the question that Darryl just asked, with the sense, we have strong conviction that it's the right move.
2 days of Powell testimony on Capitol Hill coming up a little bit later on this week. Let's see how much confidence and conviction he has. Equity futures right now on the S&P negative by 0.1. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Boeing has confirmed it's in talk to make Spirit Aerosystems part of the company again. The part suppliers at the center of the issues impacting Boeing's 737 MAX jet. Boeing said in a statement, quote, "We believe the reintegration of Boeing and Spirit Aerosystems manufacturing operations would further strengthen aviation safety, improve quality, and serve the interests of our customers, employees, and shareholders." Amazon's Whole Food grocery chain is planning a new small format stores for big city aimed at serving quick trip urban customers. The stores will be between 7 and 14,000 square feet. They won't have a buffet bar or meat counters. The grocer has signed 5 leases in New York City for the concept. The first Whole Foods Market Daily shop is slated to open on the Upper East Side by the fall. Dune 2 has taken the top spot at the weekend box office. It netted ticket sales of $81.5 million in the U.S. and Canada. That's the biggest opening of the year so far and the largest since last year's Taylor Swift film. The sci-fi sequel blew past conservative estimates, and some fans packed theaters for 3 a.m. IMAX screenings. That's your Bloomberg Brief. John.
Danny, thank you. I watched Dune 1. I think I left 15 minutes before the end. I have no idea what happened in the movie. Still to this day, do not understand it. And I will go and watch Dune 2, Bramo, just to make that happen.
Wait,
and we'll see if
seriously?
I can catch on. Just see if I can catch up.
Okay, that means that you enjoyed it secretly. You walked out before you're going back for more.
It. Big like worms underneath the desert.
I haven't seen it, so I can't wait.
Finish the end of Dune 1
I mean,
before you go
seriously.
see Dune 2.
And Chalamet doesn't strike me as like a hero type character.
What do you
know
think
what I
he
mean?
strikes you
I mean,
as?
it should be like, some high
Wonka?
school dude at Mean Girls or something like that.
Well, he wasn't Wonka,
Yeah, maybe.
Did you see
Maybe.
Wonka?
I haven't watched that yet.
Okay.
I will.
Is that
Not the
next
kind of thing I'd go to the movies for. Up next on this program, a critical week on Capitol Hill.
I do believe that President Biden is getting that sense of urgency. I think we are seeing a campaign that post Super Tuesday is going to go all in on the ground and knows what we got to do to get the job done.
That conversation coming up next, live from New York. This is Bloomberg.
It's a huge week in politics. Tomorrow, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kayleigh Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting tomorrow. Bloomberg, context changes everything.
So much Dune 2 feedback. Some of you are clearly very passionate about this. So I'll be respectful of the movie, okay? Equity futures on the S&P 500, negative here by 0.1%.
Who are you?
Are you doubting I will be?
Well, okay, what kind of feedback did you get? How could you not like the worms?
No, apparently I'm jealous of Chalamet, apparently. Yields up 3 basis points on a 10-year, 421.50. Under surveillance this morning, a critical week on Capitol Hill.
I do believe that President Biden is getting that sense of urgency. I traveled with him 2 weeks ago. I spent 8 hours with him. They're starting to put the resources we need to see into Michigan. I think we are seeing a campaign that post Super Tuesday is going to go all in on the ground and knows what we got to do to get the job done.
Here's the latest. Super Tuesday kicking off a big political week with voters in 16 states heading to the polls. This ahead of Fed Chair Jay Powell's semi-annual 2-day congressional testimony. President Biden rounding out the week with his State of the Union address Thursday evening. Ed Mills and Raymond James saying this: the State of the Union is arguably more important to Biden than Super Tuesday. This is the real launch of his re-election campaign. I'm expecting a victory lap on the economy and Bidenomics. Politically, voters will be watching Biden's stamina in the speech, and it's a chance to quiet doubts over his age. Ed Mills joins us now for more. Ed, we've heard the president talk about shrinkflation. Can you tell us whether that's landing with the electorate and whether you expect to hear it on Thursday evening?
I have not had a single client or kind of conversation about shrinkflation in the conversations. I think it is part of what he would consider some of the pocketbook issues. He certainly has made a big deal about the junk fee agenda. We could get something this week as well from the CFPB on credit card late fees. But what he's trying to do is take what is sometimes esoteric in DC and connect it to the voter. And on shrinkflation, it is an attempt to say, it is not kind of the policies of DC that are leading to your grocery bills being higher and your products being smaller. They're trying to shift it towards the greed of corporations. I don't think a lot of voters are giving them the benefit of the doubt on that, but that's the political attempt here, John.
Well, and if you look at the polling, and our recent polling as well showed this, is that you are seeing that the electorate is starting to feel a little bit, slightly more optimistic about the economy, but they still give Biden poor remarks on the economy. So what does he need to say on Thursday that makes the electorate feel good that he can deliver a strong economy if he was given another 4 years?
So we often talk about, kind of it's the economy stupid as the kind of campaign theme in 1992 and how Bill Clinton was able to connect on that. But the other part of that was that he felt your pain. And I do think what is missing out of the Biden campaign so far is that connection that they understand and really are moving policy towards understanding that it's not just a conversation about how look at how great disinflation has been, because so many times when average Americans go into the supermarket, they're seeing smaller products, they're seeing more expensive bills. We might have an inflation that has gone from, kind of 9% down to 3%, but groceries over the last several years are still up 25%. We're not hitting deflation. So it's a very hard thing to do. So I think what we've seen in the polling data that you mentioned, Annmarie, is that so far this election has been a referendum on Biden, and he's behind. For him to turn that around, he has to make it a referendum on Donald Trump and why he would do better over the next 4 years. It's just a question on whether or not he's going to be able to do that.
Well, the Wall Street Journal this morning in their editorial board says now there's panic within Democrats, and they're saying they're counting on a boffo State of the Union speech this week, Trump's well-known capacity for self-destruction. But they end with the fact that if the polls are this bad for Biden in June or July, the pressure will rise for the president to yield to a younger nominee. Is this remains to be just fantasy land on Wall Street?
So every time I have a conversation, and I'm at the Institutional Investor Conference for Raymond James right now about the election, the first thing they ask is there going to be a switcheroo, not only on the Democratic side, but on the Republican side? What we consistently tell folks is that the most likely outcome for this election is Trump versus Biden. But when we look at Super Tuesday and we look at what Nikki Haley said yesterday on the Sunday morning shows, where she was not willing to say that she was going to endorse Trump, increasingly, we're getting the question is, are we going to see a third party run? Is there something about this campaign that we don't know yet that's going to disrupt it? There is a possibility of an open convention or a change at the convention. I just think it's very undemocratic to change that late in the year. And it's a very risky strategy. So it has to be really bad come June, July for them to switch this out at the convention.
The fact that everyone's asking you this and that we hear this also, that basically people don't believe that we actually are getting this rematch, that it appears that we are getting it. Does that mean that people are not accurately pricing the way that they will the possibility of another Trump-Biden run?
Lisa, you're totally right. And I think they're also not looking at what happens after the election. So we put out a report this morning that talked about the most likely scenario is arguably a Republican sweep. The second most likely scenario is a Democratic sweep. And so we're giving about a 65% odds that there's going to be a sweep in this election. And when we look at a sweep, what does that mean? That's budget reconciliation, where all the major pieces of legislation that has occurred in this country in the last 20 years is through reconciliation. We have huge issues on the tax cuts, on Obamacare subsidies. Will the filibuster remain if there is a sweep? So they're kind of not fully convinced it's Trump versus Biden, and they're sleeping on the fact that we could have a sweep of either party. And if it's Democrats, it wouldn't be 50 Democrats that was in 2020 because you had Joe Manchin, Kyrsten Sinema. You'd actually have 50 real Democrats in terms of what they are willing to vote for. Huge market implications if that were to come to pass.
And when it comes to Super Tuesday tomorrow, some of these primaries are closed, some of them are open. What are you looking for in terms of the data? We know that Trump is going to win, but in terms of the data, what can it tell us about his electability come November?
Yeah, Annmarie, I think the last time we chatted about this is that you talked about if you had Biden getting the numbers that Donald Trump had in some of these election contests so far, there would be alarm bells in the Democratic Party. We will be watching how much of a ceiling is there for Donald Trump. The best he's done in the big primary so far is at 60%. We're going to look at the data to see, are there certain Republicans who are showing up and they're telling exit pollsters that if it comes to November, they're not showing up again or they're not willing to vote for President Trump. So the size and the scope of the victories are going to be really important to give us that sense of the strength or weakness of President Trump going into the November election.
Ed, thank you, sir. Ed Mills there of Raymond James. Getting us all up to speed on the week ahead down on Capitol Hill. We need to get up to speed on the week ahead for financial markets worldwide. The ECB kicking things off for central banks this month on Thursday. Coming up very shortly, Morgan Stanley's Seth Carpenter weighing in on the road ahead for global central banks, talking about data dependency and how they are dependent on different data points in different ways from the ECB to the Federal Reserve, Bramo, over the next month.
Don't you love data dependency? We're just data
It
dependent.
frustrates me all the time. I talk about it so much.
I know.
You know, it's like this throwaway line from central bankers.
Right.
We're data dependent.
Right. Which data, how dependent, how much are you going to respond, et cetera. Right now, it's basically show me the money, show me the disinflation. Otherwise, we're going to be patient.
Seth's going to break it down next on this program, live from New York City. This is Bloomberg. It's been a strange morning so far. David Kostin of Goldman Sachs saying it's different this time. It was different this time. Nuria Rabini of Rabini Macro Associates saying the biggest risk right now is upside risk, Bramo. Get your head around that.
I was looking forward to the mega threats guy coming out and saying, we got some mega threats. Not so much, maybe longer term or medium term. But this really highlights just how much people are getting on board behind 15 record highs in 2024 and the potential for many more.
An amazing run of gains, another record high on Friday. Equities right now pulling back just a touch. We're down 0.2% on the S&P 500, unchanged on the NASDAQ. Switch up the board and get to the bond market. 2-year, what a ride it's already been this year. A lower 4.1%. A higher 4.7. We're higher this morning by 5 or 6 basis points of 458.72, going into a monster week, Lisa, for economic data.
Especially given the fact that a lot of people say it all hinges with the labor market, at least for the United States. Maybe elsewhere it'll be different. Do you see a fully employed America that have wages that are increasing at continually pace that would suggest an inflation rate above 2%?
I see an America where it's difficult to make a deal happen. This headline just crossed into Bloomberg. JetBlue announces the termination of its merger pact with Spirit. Hardly surprising, AMH, when you see how difficult it is to make a deal happen in Washington.
When it comes to this FTC and this DOJ, they are going after a lot of these M&As, saying that this will be monopoly in the industry. We've seen this in a number of instances. And I think to your point, Jonathan, this isn't a surprise, but it is confirmed now. JetBlue saying that they will terminate this merger pact with Spirit. It's not going to happen.
JetBlue up by 5%. Bramo, we can talk about 3 potential deals. Take one off and make it 2. So Kroger, Albertsons is one. Another one is Capital One and Discover. Now, if we can't make this happen, what's going to happen to the other 2?
And that's what we've heard from different people. I mean, we heard that from this idea of big banks and small banks alike being able to make transactions at a time where people are saying you need consolidation among some of the regionals. This is going to really be one of the key questions, especially with an administration shift. How different would an administration under Trump versus Biden be when it comes to antitrust? That's definitely something people are looking at.
It's hard to see where the differences are when you have J.D. Vance actually saying that one of the most effective members of the Biden administration is the FTC's Lina Khan, and saying that Google should be broken up. And then you have Senator Josh Hawley agreeing with Senator Warren when it comes to Capital One and Discover. When you look at some facets of the Republican Party and a potential Trump 2.0, they may actually be in line with what we're seeing from this current FTC and DOJ.
Shareholders telling JetBlue what they think about this. The stock is up by close to 8% on my screen right now, Bramo.
Yeah, although we haven't necessarily seen Spirit shares start to trade again since the halt. And I imagine that it'll be the opposite reaction there, where people were hoping for some sort of reprieve after a pretty poor performance.
JetBlue announcing the termination of the merger pact with Spirit, the latest news on a Bloomberg just in the last couple of minutes or so. Under surveillance, our top stories elsewhere. Let's start with this one. OPEC Plus extending its oil supply cutbacks to mid-year in an attempt to shore up prices and avert a global surplus. A curb of about 2 million barrels a day will remain in place until the end of June. Russia also promising to play its part by focusing on cutting production rather than exports. The OPEC extension was widely expected, but gives oil room to run in the near term. Ample supplies have anchored international prices near $80, even as conflict in the Middle East disrupts regional shipping. Annmarie, Brent crude right now, 83.38. WTI, 79.68.
I think what we're seeing here is OPEC put a serious floor on prices. We have seen the cartel really want to ratchet back some of those supplies because they're dealing with slower demand in China as well as ample supplies from the United States. But I think this story gets a lot more interesting later in the year. While Saudi Arabia, we know, is by some accounts needs a much higher oil price, you have a country like the UAE that's sitting on 1.5 million barrels of just idle capacity. They spent all this money to try to get more production, and they're being told they can't use it.
The good news for the president, the crude is lower and not higher. Good news for the president, the gasoline is lower and not higher, because we'd have a very different conversation going into Thursday evening.
The other good news he's not going to talk about, and this, I think, is really one of the key questions, which is basically, is OPEC Plus ceding some of its market share to the United States? The fact that it's cutting and the U.S. is making bank because they're increasing production.
Isn't it ridiculous?
It is. And that's the message that he could be sending, but it doesn't really go to some of the green politics.
Well, Donald Trump, I heard him again the last few days talking about drill, baby, drill. We need to remind the former president that we are north of 13 million barrels a day. It's a record for any country ever, but it's one that this administration doesn't want to lean into.
We don't need to remind him. The current president does, and doesn't want to. And that's the issue at play here.
It talks to trying to speak to different constituencies with rivaling kinds of goals. But, ultimately, the U.S. is that swing producer. And the fact that OPEC Plus is going to keep the cuts means the U.S. can keep trying to take share.
That State of the Union address coming Thursday evening at around 8 p.m. Eastern time. Oil, crude, gasoline prices probably won't be discussed that much. He's hoping to sway voters on Bidenomics and address concerns about his age. White House aides saying Biden will promote his economic agenda, including the CHIPS and Science Act, as well as a push to kill junk fees for consumers. Biden has also been advancing the idea of raising the corporate tax rate from 21% to 28%, as well as a capital gains tax for billionaires. Let's pick up on the last point, capital gains. They couldn't make it happen this time around. Why are they going to make it happen anytime soon?
Well, I think, to Lisa's point, it's going after certain constituents within your party. This is an administration that, when it had control, Democratic control of the House and the Senate, couldn't close the carried interest loophole. Yet they're talking about raising corporate tax rates. I don't see it happening if we have a divided government, because it couldn't happen when the Democrats had control of the entire government.
Thursday evening, a big evening for the President of the United States. A monster week ahead, not just for the President, but also for Wall Street, including a double dose of Chairman Powell, a central bank rate decision, and key U.S. data. On Wednesday, we'll get JOLTS and ADP private payroll numbers. This as Powell begins his two-day semi-annual congressional testimony before the House. Thursday, Powell testifying before the Senate. Plus, we'll get an ECB rate decision. And Friday, the U.S. February payrolls report. Morgan Stanley's Seth Carpenter joins us now for more. Seth, you framed it perfectly, I would say beautifully, in your most recent note, the Fed versus the ECB. Can you walk us through the difference in being data dependent in Europe and being data dependent in the United States?
Yeah, I have to say right now it's a bit more difficult for Chair Powell. I think in the Euro area, President Lagarde and her colleagues, they're looking at inflation. Is inflation coming down? Is it coming down fast enough? They've got weak growth. The German economy, especially the manufacturing part of the German economy, already in recession. Whereas if we look at what's going on in the U.S., and you all at the top of the hour mentioned some of the comments by Nouriel Roubini. I saw Bloomberg headline saying he used the phrase, is the risk of a no landing scenario, i.e. inflation staying high and growth staying high. That's really the tricky part for the Fed. They have to worry about both. You mentioned non-farm payrolls. We've got that coming up. We see a bit of a step back from last month, but nothing particularly weak. So we're at about 200,000 for the month, less than that, 160 or so private payrolls. So slowing down, but not collapsing. And so the Fed really wants to see both inflation continuing to come down and growth softening up a bit, because they don't want an economy that's going to leave inflation 6 months from now, a year from now, above, say, 2.5%.
Seth, I'm sure you heard what Torsten Slok of Apollo had to say last week. Coming into this week, we picked up on those comments with him a little bit earlier this morning. Torsten reckons that maybe you get, in fact, his base case is no cuts in 2024. Seth, what would you need to see in the data for that to become your base case?
I think that's a great thought exercise to do. I'm deeply skeptical that that's where we end up. But what do you need to see? I think you need to see the real side of the economy continue to roll. So 250, 300,000 non-farm payrolls, not just this month, but continuing through all of the first half of the year and into the second half. I think you'd also need to see, though, inflation not coming down. Now, remember, there's been lots of discussion, new data coming out about population and migration. So maybe, just maybe, we could have stronger job growth with inflation coming down. So that, for me, is really the trick for the Fed. They have to look at both inflation, where it is now and where it's going, and the real side of the economy at the same time. And so I think you'd have to see substantial outperformance from both of those variables in the economy.
Seth, Torsten was talking about one of the main reasons why he did revise his view, which is financial conditions and how much they've eased, especially given all of the bond sales, corporate bond sales, IPOs, deals that are trying to get through, even if they're not being allowed. How much have you seen that as materially shifting higher your outlook for inflation and growth in the U.S.?
Yeah, I think the tricky thing with financial conditions really is which particular corner of the world are you looking in and what's your starting point for the comparison. So I think if you're looking from, say, October when the 10-year rate was near its peak through till January when we had this pretty substantial rally, it's easy to make that narrow case that things are a lot easier. But if we take, say, the corporate bond issuance that's been going on, any refunding, any refinancing that corporations are doing from 3 years ago, 4 years ago, 5 years ago, they're refinancing into much higher rates than what they had been paying. And so I think it's a bit of a double-edged sword. Look at banks. If we look at banks, even though short-term interest rates, the Fed's policy rate has not changed since July, the share of deposits that are sort of retail and low-cost deposits has been going down, whereas the share of wholesale funding for banks where they have to go out in the market and pay market rates has been going up. And so there, even with the Fed's policy rate staying constant, the cost of funding has been going up over time since the Fed stopped hiking interest rates. So I don't think it's quite so easy to just say, by and large, across the economy in a wholesale way, everything is just so much easier that it should support the economy.
So, I'm struck by something else that Torsten was talking about, this idea that keeping rates at 5.5% is hurting disproportionately small businesses, households, particularly lower income households, groups that are more highly levered and don't necessarily have their assets in savings. How much do you think that's weighing on the Fed? That basically right now, even if it's not crimping the big companies and you're seeing stock valuations continue to rise, there are some real serious harmful effects on a swath of less opulent areas.
I think it's impossible to get away from the idea that monetary policy, which is a very blunt tool, has a differential effect across different folks across the economy. I remember way back when I was a professor, I wrote a paper on the sort of asymmetric or the differential effects of monetary policy across the economy. So I think that's very, very real. And I think the type of crimping that you're talking about is, unfortunately, exactly what you would expect. Monetary policy is blunt. It is the Fed raising the cost of borrowing. And so necessarily the people who will be affected more will be the ones who have more borrowing needs than others, those who have less alternatives in terms of how to get around the higher cost of funding. So I think that point is exactly right. But it's also very much the way that monetary policy has always worked. It's not it is potentially a bug. It's potentially a feature. It is, in my view, just a fact of how monetary policy works.
Seth, forgive me for finishing on this, but I want to inject a little bit of politics and ask you this. Shrinkflation, price gouging, their contribution to headline inflation, is that a good political argument or a strong economic one?
Oh, I mean, I think this is a real challenge. And this is where I am constantly reminded that as an egg-headed economist, I am not a real person. I talk to my family, I talk to friends who have nothing to do with the macro scene. And I say, look at that, inflation's come down a lot. And their reaction is, I am paying more than I was 2 years ago for just about everything. How can you say that inflation has come down? And of course, the answer is there's a difference between the price level and the rate of change of the price level. But in terms of politics, which is where you started, perception is reality. And I do think part of the reason why we're seeing the polling numbers so negative on the economy is the fact that the price level itself is still much higher than it was a little while ago.
Seth, perfect answer. Thank you, sir. Seth Carpenter of Morgan Stanley. Appreciate it, Seth. Good to see you. How many conversations have you had like that with family members?
I don't even try.
The world over.
Yeah, I mean, basically everyone's trying to explain inflation. The inflation rate is coming down. And they're like, did you see my grocery bill? Did you see my rent?
Yeah.
What are you talking about?
What was it for 4 years ago, before the pandemic?
I mean, basically,
I know.
It's a matter of time.
That's the challenge for the president on Thursday evening, to try and connect with those people. Equity futures right now on the S&P, negative here by 0.2%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Shares of JetBlue are rising after the company announced the termination of its merger pact with Spirit. The July 2022 merger of the two airlines had been valued at $3.8 billion. But the Department of Justice sued to block the deal, alleging it would stifle competition in the airline industry. The CEO of JetBlue said in a statement, quote, "We believe this merger was worth pursuing because it would have unleashed a national low-fare, high-value competitor to the big four airlines." Apple has been hit with a $2 billion fine by the European Union over its App Store rules. The EU says Apple abused its dominant market position for the distribution of music streaming apps, preventing users from being told of cheaper deals outside the Apple ecosystem.
The Commission found that Apple's rules result in withholding key information on prices and features of services from consumers. As such, they are neither necessary nor proportionate for the provision of the App Store on Apple's mobile devices.
It's the EU's first fine against Apple and follows a complaint from Spotify. Apple has rejected the ruling, claiming regulators failed to uncover credible evidence of consumer harm. NVIDIA has notched another milestone. It's now the world's third biggest company. The chipmaker's rally drove its valuation past $2 trillion for the first time. NVIDIA's Friday close put it third on the list behind Microsoft and Apple. NVIDIA shares have risen more than 66% this year. That's your Bloomberg brief. John.
Danny, thank you. Message from a Bloomberg subscriber just across the Bloomberg right now. With Rabini turning around, now I'm worried. Now I'm worried.
See?
I've seen a lot of that.
I know, but then it's like, really? That's what you're also going to get? I also did get a message on the Bloomberg saying, no, the opposite. Really? You're worried that there aren't enough people worried? Was that really how low you've stooped?
If you missed it a little bit earlier, Nouriel Rabini saying the biggest risk right now is upside risk. Up next on this program, Macy's gets a better offer.
We are very hopeful that we can increase our offer if we get access to that relatively limited diligence that we need. And for that reason, we've made the request. The response was, unfortunately, from the company that it was premature to even begin negotiating an NDA.
That conversation up next, live from New York City. You're opening about 45 minutes away this Monday morning. Equity futures on the S&P 500, slightly negative. We're down by 0.2%. $42 minutes away from the opening bell. Equity futures on the S&P negative here by 0.2%. Yields bleeding higher by 4 basis points, 4.22 on a 10-year. The euro a little stronger against the weaker dollar, 108.46. So raising some of that strength though as the session progresses. Under surveillance this morning, Macy's getting a better offer.
We are very hopeful that we can increase our offer if we get access to that relatively limited diligence that we need. And for that reason, we've made the request. The response was, unfortunately, from the company that it was premature to even begin negotiating an NDA. We've expressed that to Macy's. We've walked them through our capitalization. And on multiple occasions, they've told us, over the last 7 weeks that they had no additional questions with respect to our financing.
Here's the latest. Ark House and Brigade Capital raising their bid for Macy's, now offering $25 per share to take the company private. Macy's still reviewing the offer after unveiling a restructuring plan, which would close a third of U.S. locations. Sucharita Kodali of Forrester Research joins us now for more. Sucharita, can I ask you then just bluntly up front, does this get the deal done?
Well, I think it really depends because there are still a lot of unknowns. Macy's doesn't have
the answers that they had asked for before on how the financing was going to happen. And the buyers, it sounds like they don't necessarily have all of the details from a due diligence standpoint that they had asked for either. So there are a lot of things that are still in the air. The numbers seem to look attractive, but whether or not they can actually make it happen in this high interest rate environment, I think, remains to be seen.
Let's say they can. Do you have a decent understanding of what would happen to this company?
Well, typically the playbook when there is an acquisition of this sort is that usually the assets are harvested and there is essentially a slow decline in the retailer. And the biggest assets here are really the real estate properties. What's going to happen with that Herald Square store and other assets that they may have that are physical bricks and mortar stores. So that's really the question. I think that they will probably try to persuade the shareholders of a slightly different story, that they will preserve jobs and they'll preserve the locations that have been announced, that they'll stay open. But I think that it is hard to envision that they will be able to turn that the department store sector in general, or the apparel sector, is going to have a major turnaround that would reverse the fortunes of Macy's anytime soon. So I unfortunately do think that this is probably headed into the direction of maybe, the outcomes of some of the other private equity retail acquisitions that have happened over the years.
Where it really is about the real estate more than anything else. Given that, what do you think has gone so wrong at Macy's? Do you think it's just an environment issue that the department store is having a hard time, or do you think that it's a Macy's-specific issue that's caused its shares to drop 10% this year and a whole lot last year and the year before?
Well, I think a lot of it are the macroeconomic factors. The truth is that the entire department store sector has been under pressure pretty much since 9/11. It kind of peaked around the year, 2000, 2001, and has been just on a downward trajectory since then. A lot of it is due to competition. It's everything from companies like Amazon that have been in their space. It is the mass merchants that have encroached the apparel category more and more. It is specialty retailers like Sephora. And increasingly now, it is new Chinese upstarts like Shein and Temu that are absolutely eating into these kind of sales of the department stores. Now, has Macy's executed badly? I think that they have done pretty well given the circumstances. They've leaned heavily into sectors like private label, apparel, and other merchandise. They've opened these small format stores. They have leaned into luxury with Bloomingdale's, which is relatively resilient. But the truth is it's not enough. The Macy's flagship brand, which had been, for the most part, a series of a lot of department store acquisitions over time, it's just been really, really challenged. This is one of the apparel is one of the toughest sectors in retail overall. Department stores are really challenged even within the apparel sector.
So what's your sense that if this transaction goes through, it'll be basically broken up, sold off for the real estate, and just sort of left as a vestige of its past?
Well, that is, or it could go into bankruptcy. I mean, there are any number of outcomes. I mean, you see this in the office supply sector. You see this with what happened to Toys R Us. I mean, private equity and, kind of acquisitions of this sort just don't necessarily, I've seen very, very few great outcomes for retailers. And that's why I am a little skeptical for the future of Macy's, skeptical about the future of Macy's. But that said, at the same time, I don't necessarily see a path for them to get back to, stock value, stock price of $70 either. So given that outcome, this may actually be, from a maximization of shareholder value standpoint, the best that they've got at this moment in time. I also think one consideration is that commercial real estate in New York may not be at a premium. And one of course, the biggest assets of Macy's is that Herald Square store, which is essentially an entire an entire city block there. And the big question is, in a better environment, could it have basically unlocked more value for the retailer?
Do you think if this deal was to happen, they would go through with closing almost a third of those shops, though? And can you see them leaning in more towards this luxury retail?
Well, they'd already announced, even kind of separate from this deal, 150 store closings, and I don't think that anything is going to change or reverse that. It sounds like they were very, very underperforming stores that barely generated any revenue for the brand altogether. In terms of can Bluemercury and Bloomingdale's solve their problems, the issue is that Bluemercury in particular, while likely high margin and very, very strong from a consumer loyalty standpoint, it's a small format store and it's only going to generate so much in revenue. It's never going to offset the revenue that a larger format department store could be able to generate. They'd have to open a heck of a lot of Bluemercuries to make up for one Macy's store. And as far as Bloomingdale's is concerned, there's potentially some promise there, but the challenge in luxury overall is that a lot of those brands are opening their own stores, and you're sort of catching a lot of newer brands on the rise, and that's tough.
Yep. Sucharita, appreciate your time today. Sucharita Kadali there of Forrester Research on Macy's. Macy's in the pre-market right now. Where are we? I'll pull up the stock quickly. Positive by 14%. It's quite a pop. Still below the offer price of 24. We're trading at about 20.6 in a pre-market, 33% premium. Bramo to Friday's close.
Yeah, given the fact that this maybe offers more value, unlocks more shareholder value, what's the threshold that we really even have for why this deal didn't get done the first time?
We're going to find out what the threshold is now, hopefully a little bit later. Coming up tomorrow, this is what we look like. Greg Barrell of BNP Paribas, Samara Cohen of BlackRock, JP Morgan's Elise Ossenbar and Lauren Goodwin of New York Life Investments. A lot to talk about. We'll pick up on that conversation, why Nouri Al-Rabini is actually pretty constructive and not that bearish, and why Torsten Slok sees no rate cuts in 2024.